without any regards to natural communities. There is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube-sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, e-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism dies, in the case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Businessweek with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, streaming on YouTube. We made it to another Monday, May 17th, 2021. We've got both stocks and bonds. They're kind of moving the same direction, down again. But that's not really our focus, is it?
No, media merger Monday. That's certainly my
focus.
Is
it a merger? Is it an acquisition? Because things are mostly never a merger. We were talking about this before.
$130 billion is the price tag, or the value, I should say.
Listen, time will tell, but it's all about streaming and content. Yeah. We're going to hear from the two big CEOs behind it over at AT&T and Discovery. You will be hearing them live on this broadcast. We're going to talk about that. We're going to talk about the big crunch, who is panic buying now, and then we're talking shop, classic cars with Jay Leno.
It doesn't get much better than that for a Monday, Carol.
This is kind of what we call an all-star lineup. All right, speaking of all-star, he is back. Charlie Pellet, checking on the trading day.
And
welcome back.
Thank you so much. I am glad to be back, and here's what's going on. Let's talk about AT&T. Let's talk about Discovery right off the bat. Shares of both companies, they are moving lower. Again, we've got the CEOs coming up. 3 o'clock Wall Street time. AT&T down now 0.2%. Look at Discovery down now by just about 4.6%. Stocks are falling on this back-to-work Monday. The dollar's weakening as investors weigh risks to the economic outlook, including inflation and a jump in COVID-19 cases in parts of the world. Tech and communication services leading the benchmark S&P 500 into the red for the first time in 3 sessions. Apple and Microsoft weighing on the NASDAQ 100 index. Right now, Apple is down 1.6%. Microsoft tumbling 1.75%. NASDAQ 100 index down 1.3%. NASDAQ Composite Index down 1.1%. Lower by 142 points. S&P down 24, down 0.6. The Dow is down 124, down 0.4. 10-year yield 1.63%. We've got gold up 1.3%. 18.67 the ounce. West Texas Intermediate crude up 1.3%. 66.24 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie. Thank you so much. Good to have you back. Let's get to the market drivers report. And let's set the Businessweek agenda on this Monday. Dave Wilson, lucky for me, sitting right next to me on my left-hand side, stocks editor at Bloomberg News. He's been back, everybody, but he hasn't been back in our interactive broker studio. He's here along with Ritika Gupta, reporter at Bloomberg News. She's on the phone from JP Morgan headquarters in New York City. We'll get to her in just a moment. Welcome back in studio. Feels
Thank
good.
you. Yeah.
Feels good.
Feels normal.
Yeah, and you're back after a week off.
Yeah, absolutely.
Feels normal.
It's getting there.
It's getting there. How about the trade today? It does feel like sometimes we're up, sometimes we're down. That's kind of normal.
Yeah, of course, now we're kind of toward the lows of the day. I mean, you got a lot of stocks kind of weighing on things at this point. Notably, companies kind of tied into this whole deal with AT&T and Discovery. You have one of the classes of Discovery shares down. You have Comcast down. We actually had a report out of Bloomberg Intelligence saying, you know, there's a possibility that Comcast may go after either Warner Media, AT&T's unit, or Discovery.
That's how it rolls in media, right? It always gets a little messy, I feel like.
Yeah, absolutely. And you've certainly got that potential at this point. So, you know, that's one group that definitely jumps out.
Dave, you also have companies like Charter Communications down as well. Is that because, you know, when these content companies get bigger, they can negotiate from a stronger position and play these, the pipes, you know, not to their advantage?
Yeah, there's certainly that potential. And, you know, you figure with a bigger company, more leverage over the cable operators makes perfect sense. You got to wonder what a company like Charter does in response to all this, too. I mean, let's not forget, Comcast has got NBC Universal, and that's why, you know, you have Bloomberg Intelligence writing what it did in terms of where they may fit into the plans of AT&T and Discovery or not. I mean, but beyond that, I mean, you figure media companies across the board have to respond to whatever is going to happen here.
Well, there was a point when it was all about the pipe, right? The delivery. Yeah. They didn't care what kind of content. Now it's much more, I feel like, about the content and material. All right, let's get to one of the groups of the day, flat on the day, financials, unchanged as we speak. JP Morgan, though, shares up about 0.3%. Ritika Gupta, outside JP Morgan headquarters on Park Avenue, are you seeing a flow of JP Morgan workers coming back to work?
Hi, Carol. Yeah, it is pretty busy out here. Patagonia vests really out here in full force, but it is a big day here for JP Morgan across the U.S. They're opening all of their offices on a voluntary basis. I'm outside the New York headquarters. That one actually has been open throughout, and as I mentioned, it's been really busy here actually. This is really important because we know that they are going to be making all of their workers go back to their offices on a rotational basis, at least in July. All the other banks are going to be watching this. This is the first major bank to have a mandate to bring all of its workers in the U.S. back to offices. So they're going to see how it's done, particularly now, though, because we've got more than 200 million doses of the vaccine administered here in the U.S.
Well, when it comes to the economic recovery, especially here in New York City, Ritika, it's not just about those bank employees going back to work, but all about the people outside the bank, those folks who are the ones who sell them coffee at the coffee cart and lunch at the lunch spots nearby, and people who work in the pharmacies nearby as well. Just describe the activity that you're seeing on a day like today, because you can certainly hear that there's activity going on behind you.
Yeah, you can hear just all the commotion, but you're totally
Sounds like
right.
New York City.
This extends, exactly, this extends way past just the organizations and businesses and banks wanting their workers back. It's like you said, the coffee shops, the local restaurants, those all relying on the business of workers coming out during their coffee breaks. And without that, you know, it's really not great for them. So it's kind of like, I feel like I'm starting to see more signs of life back into the city. It's really important for the local economy, Tim.
Yeah, I've definitely seen life coming back into the city over the last couple of weeks. Speaking, though, of financials, it's your second best performing group here in 2021. It's up, Dave, about 28%. JP Morgan is an important one to watch. It's a bellwether when it comes to Wall Street and the big financial big banks.
Oh, yes, absolutely. And if you think about it, financials sort of fit into a bigger theme that's been playing out in the market for the last several months, the whole shift toward value, cheaper stocks relative to sales or earnings or whatever, and away from the faster growing companies, especially the ones that we consider to be big tech, whether they fit in the S&P 500 technology index or not. So, you know, that's definitely been something to watch. And financials really at the forefront of a lot of the value indexes. And so, you know, as that group goes, so goes that bigger trade. in large measure at least.
Yeah, talk a little bit about that, Dave, because information technology, the worst performing sector right now, down 1.38% in the S&P 500. What you seeing there?
Well, one thing that jumps out is that if you look at what stocks are kind of leading the way down, chip makers and chip equipment makers, which is interesting because those are groups that have really benefited in the last few weeks from the whole focus on chip shortages, especially in the auto industry. But like anything else, it's a matter of, how quickly can the industry respond and can they do it profitably? I mean, these are all the kinds of issues that sort of jump out. And so you see a bit of a retreat in most of these shares. Notable exception, disk drive makers. I saw a report on a site, Tom's Hardware, that was saying that there's this new Chia coin.
I love this story.
Yeah, absolutely.
It's among my gainers I'm watching today. Seagate and there's a couple of other ones.
Digital.
Western
Those
Digital.
Two. Yeah, Chia coin. That evidently there is such a push to mine that particular coin that there's a shortage of hard disk drives. The ones that we have on our personal computers, those bits of equipment in Western Digital and Seagate, they're both up about 5% at the moment.
They're high-capacity hard drives, and that's what you need to mine them and to really kind of control them. And they're also being kind of pitched as maybe a greener type of crypto. So it's really cool. These stocks have been on a tear. Dave Wilson, thank you so much. So good to have you back in studio. And our thanks to Ritika Gupta, too. We'll check in with her a little bit later on.
Let's do the Bloomberg Businessweek Bite of the Day. It's one number that tells us a lot. It's brought to you by GEP. GEP helps businesses transform supply chains with managed services and AI-based cloud-native software. Learn more at GEP.com.
All right, today's number, really easy. 1. Henry Ford's great-great-granddaughter has become the first woman in history to take a seat on the company's board of directors. Alexandra Ford English, she's 33. She's got an MBA from Harvard and undergrad from Stanford. She's going to begin her tenure at the 14-member board immediately. English is the daughter of the company's executive chairman, Bill Ford. You've seen him a lot on our air. She joined the 118-year-old company in 2017 and works as director of corporate strategy. So took him long enough. That's all I'm going to say.
Yeah, it did. Very cool stuff.
It is cool stuff.
All right, in the meantime, let's get a check on the latest world and national news with Karen Chase in the newsroom here in New York.
President Biden just announced plans to start exporting our excess supply of COVID vaccines as they become available, starting with 80 million doses. The president said the U.S. must continue to lead efforts to fight the virus, and he expects to announce a specific milestone in progress at the upcoming G17 summit in June. The U.S. Supreme Court has agreed to take up a controversial case that could result in sharply reduced abortion rights. Bloomberg's Amy Morris tells us justices have agreed to hear Mississippi's bid to ban abortions in almost all cases after just 15 weeks of pregnancy.
The Mississippi case seeks to allow states to outlaw abortion even before a fetus is viable. That eviscerates the core holding of a 1992 ruling which says states can't impose significant restrictions before viability. Conservative states have been moving to sharply restrict abortion rights. So far in 2021 alone, states have enacted more than 60 new abortion restrictions. The Supreme Court will hear this case in the upcoming term that begins in October. In Washington, I'm Amy Morris, Bloomberg Radio.
Secretary of State Anthony Blinken, now traveling in Europe, has been working the phones, talking with leaders of Middle Eastern countries in efforts to bring about a ceasefire between Israel and Hamas. Bill Gates initially said he was stepping down from the board of Microsoft to devote more time to philanthropy, but his resignation came right after the board conducted an investigation into his inappropriate involvement with an employee almost 2 decades ago. Gates and his wife recently announced plans to get a divorce after 27 years of marriage. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karen Chase, and this is Bloomberg.
All right, Ann, thank you so much. You're listening to Bloomberg Businessweek. Carol Master along with Tim Stanovic. A couple of stories when it comes to COVID and the vaccine. New York, though, lifting its mask mandate on Wednesday for vaccinated people as COVID vaccinations approach 50% of the state's residents and cases and hospitalizations. And this is coming from New York Governor Andrew Cuomo. He held, of course, he's been doing those daily briefings, but that out of his briefing on today.
Yeah, he said, quote, all the arrows are pointed in the right direction, so let's get back to life. We need to get the exuberance back, the excitement back. He called the easing of the mask mandate a, quote, radical adjustment of rules and guidelines, and said the state took a couple of days to analyze the guidance and align it with its own. Masks will still be required at schools, public transit, correctional facilities, and healthcare settings. So similar guidance to what we saw from the CDC, where it's like, okay, masks off in certain settings, but if you are on public transit, if you are in a healthcare setting, you got to keep it on.
Right, exactly. And we're all kind of finding our way with this, because I know I was kind of out and about a little bit in the city this past weekend, had my mask on.
You did have it on? Outside?
Yeah, most of the time. And a lot of people, it was a mixture, but there were still a lot of people with masks on.
You got to come to Brooklyn.
Yeah.
Yeah, we just tore those things off all weekend, enjoyed the sun. I felt like nobody was wearing masks outside at least, but it's a completely different story when you walk into a building. Walking into stores and stuff, though, it was very risk, and there were lines, and they were controlling how many people were in there. In the meantime, we did hear from the president just a short while ago. President Biden planning to send an additional 20 million doses of U.S. coronavirus vaccines abroad by the end of June, including for the first time. Shots authorized for domestic use where supplies beginning to outstrip demand. So basically looking, I guess, at our overflow and looking to share it with the rest of the world. Right, specifically shots from Pfizer, Moderna, and Johnson & Johnson. That's on top of the 60 million AstraZeneca doses that had already been planned to give to other countries. That's according to a senior administration official familiar with the plan. But we know now that Biden has announced that. And look, New York City is going to host its marathon, isn't it? Yeah, it is. That's a big deal. November 7th, 33,000 runners, about 2/3 capacity. Registration opens June 8th, everybody. New York is coming back. Yay. This is Bloomberg Radio.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. The tech sector's leading stocks lower. The Dow, the S&P, NASDAQ, all in the red. Investors are weighing risks to the economic outlook, including inflation, along with the jump in COVID-19 cases in parts of the world. S&P down 22, lower by 0.5%. The Dow down 105, down 0.3. NASDAQ down 133, a drop there of 1%. 10 years down 2/32. 10-year yield 1.63%. We've got shares of Apple and Microsoft weighing on the NASDAQ 100 index. Apple shares down 1.6%. Microsoft shares down now by 1.7%. NASDAQ 100 index lower by 1.2%. Gold up 1.3%, $18.67 the ounce. West Texas Intermediate crude up 1.5%, $66.37 a barrel. Bitcoin back below 43,000. Right now, Bitcoin down by 2.5%, 42,977 on Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Tim and I just going through some of the day's virus and vaccine headlines. Keep in mind, the U.S. yesterday recorded its lowest number of new coronavirus infections since the early days of the pandemic. That's not necessarily the case, though, when you look at Taiwan and some other places, Thailand also. It's a little bit tricky.
Yeah, there are a couple different things playing out here, but certainly here in the United States, it is encouraging. The number of new infections that we saw yesterday, the lowest that it's been in almost a year.
Feels so good.
Yeah.
All right, let's get into it. And of course, India, we continue to focus on India. It continues to be rough, but they're scaling up their inoculations for its population. Let's get to it. A trusted voice that we have gone to throughout the pandemic, Alyssa Rapp, CEO of the healthcare solutions company, Surgical Solutions, back with us on the phone from Deerfield, Illinois. Alyssa, good to have you here. How's it going? How's your team doing?
Oh, Carolyn, Tim, thanks for having me back. I'm feeling much, much more buoyant today than in past conversations. We are seeing the world reopen as people get more and more vaccinated. The access to the vaccine that we've discussed so much as a major sorting issue is no longer the case. It's in abundance available, which is awesome, and I'm feeling hopeful.
Why is that specifically? I mean, is it because of what's happening everywhere else? Is it vaccinations? Is it the general trend that we're seeing throughout the country? Because there are still hotspots popping up, and look, there are still a lot of Americans who don't want to be vaccinated.
Well, there's absolutely vaccination fear, which is a whole separate conversation per se, but why things I think are looking up, and as Carol said, the lowest number of new corona cases in a year and a half almost is awesome. Two key reasons. On May 13th, as you know, the CDC released new guidelines for fully vaccinated people. And when you no longer need to wear a mask or physically distance in any setting when you are vaccinated, there's an extra incentive to get it done. That's a big life change from the last year and a half. And then on May 10th, just a few days prior, the FDA expanded the emergency authorization for Pfizer for 12 to 15-year-olds. So now we've got 12 and up able to get vaccinated. And more people getting vaccinated, so one can debate herd immunity, but we're now seeing the positive side of vaccinations, which is the world can begin reopening and unmasking, which is a big change.
Hey, Alyssa, so we all have now a bit of a playbook, right, in terms of dealing with a pandemic. We are already having guests on, smart guests like you, those in the medical community who are already talking about the booster shots and marking their calendars. How are you planning for your employees who are on the front lines in the healthcare community? How are you planning for that already?
We are obviously following very closely state guidance, and on that, in the cases like New York State, where you all are, there are now mandatory days and half days off to accommodate the vaccine. We are encouraging that, educating our team about that, encouraging that, and letting them know there's no economic consequence of getting vaccinated or boosted. And we expect that the boosters will start to be available by the fall, and hope that they're not needed, but expect that they might be. And we'll just have to continue to make those accommodations to allow people on the front lines to take time away from their workday and get paid for it in order to get the shots they need.
Alyssa, one reason among the many we like to talk to you is you have this pulse of what's going on the front lines and in the healthcare facilities where you guys operate. And I'm wondering what you're hearing from those right now. Is the news as good as it is outside of those hospitals?
So in that sense, I won't be quite as optimistic. You know, there has been access to vaccines since December on the front lines, and we had a meaningful hesitation risk amongst frontline workers, as you heard about throughout the country, about vaccinations. We have seen that ease a bit because now that the world is reopening, and I don't know if we'll end up in a place of vaccine passports, but people are moving around again, including some of our field leaders. The lone few who were not vaccinated now are saying, oh, shoot, if I'm going to be asked to travel more for work or go to other sites, I don't want to be increasing my risk and my own personal risk going back to my home of picking it up and bringing it back to my home when there's really no excuse now, not as we start to move around, not to get the shot. And so we've seen people who had been reluctant start getting it. We've seen people who were reluctant see family members get COVID and therefore rush to get the vaccine who were reluctant. So we've seen a little bit less reluctancy on the front lines, but there is still some. And that's the piece that from where I sit, and that frustrates me because it's not for lack of education or open dialogue about the scientific benefits of it. In our case, we've done 10 town halls on the vaccine. But I'm at least encouraged that some people who had been hesitant are now getting it several months later as the world reopens.
Hey, Alyssa, there was a story that caught my attention over the weekend about COVID being airborne. Scientists were saying it now. Authorities think so too, and this has to do the World Health Organization, the CDC, and some studies that have been done by scientists around the globe. Basically, the point is that scientists are now calling for ventilation systems to be overhauled like public water supplies were in the 1800s after, pipes at that point were found to harbor cholera. So I just wonder, are we thinking about that? Your healthcare workers, hospital systems are probably, I think, ahead on this, I would say, but I'm just curious about your thoughts on that.
I just got elected to the local school board here in suburban Chicago where my children go, and we have talked about that level of advanced ventilation already and already had made some of those investments last year. I haven't heard it come up yet in the hospital setting. To your point, there's already much more sensitivity to the air quality, particularly in the operating room, and there were new mandates like smokeless operating rooms because of smoke caused by some of the equipment, not by actual physical smoking, et cetera, in the last year. So I would expect more investment required by hospitals in their infrastructure to accommodate improved ventilation settings. I would also expect it, frankly, in schools.
Hey, Alyssa, before we let you go, best guess for how long we are going to, this is going to be the go-to thing we go to you on, because it does feel like for a certain extent. Yeah. And we only have about 15 seconds left.
I think we're probably going to continue talking like this till the end of the summer.
Okay.
Yeah, I think so too. But look forward to other conversations with you. Alyssa, thanks so much. Alyssa Rapps, Chief Executive Officer, Surgical Solutions, on the phone from Deerfield, Illinois. I think the same thing. I think about that with...
I think so too. I mean, and I think, look, Davos was canceled today.
Singapore, right?
Yeah, Davos, Singapore. So that's a big deal.
Yeah.
Well, World Economic Forum, I should say.
Yeah, we're kind of watching all of that because it gives us kind of a metric on where we are.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It is a down day with the Dow, the S&P, and NASDAQ all declining. Today we've got the S&P down 17, down now by 0.4%. The Dow down 73, drop there of 0.2%. NASDAQ lower by 115, down 0.9. NASDAQ 100 index down 1.1%. Stocks fell. The dollar weakened as investors weighed risks to the economic outlook, including inflation and a jump in COVID-19 cases in parts of the world. 10-year yield again 1.63%. Gold up 1.3%, 18.66 the ounce. West Texas Intermediate crude up 1.4%, 66.26 a barrel. The United States, as we've been telling you, has recorded its lowest number of new coronavirus infections since the early days of the pandemic, as the Centers for Disease Control and Prevention says any vaccine mandates in the U.S. will be set locally. Americans who've been vaccinated are now free to shed their face masks at most times. Dr. Joshua Sharfstein is Vice Dean of the Johns Hopkins Bloomberg School of Public Health.
Well, I think it means that the actual policies in a particular area are going to depend on the rate of spread of the virus, that it may make sense in certain areas to have indoor mask requirements still because there's so many people who are unvaccinated. But in general, I think the statement that CDC was making is that vaccination just looks incredibly effective, and there's every reason for individuals to get vaccinated.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine stocks, Pfizer shares up today by 0.4%. Its German partner, the ADRs of BioNTech, up by 1.7%. ADRs of AstraZeneca up 1%. Moderna shares, they're lower, based in Cambridge. Moderna's down 1.6%. Johnson & Johnson up today by 0.5%. The U.S. Securities and Exchange Commission will pay more than $31 million to 4 whistleblowers who provided information that led to 2 successful enforcement actions. Recapping, stocks lower, S&P down 18, down 0.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that update. So, big business deal. We talked about it with Dave Wilson up at the top. Investment bankers, safe to say, probably pretty busy over this past weekend, right? It was a deal that was a Bloomberg exclusive. We announced it.
Yeah, and it, of course, involves AT&T selling its media assets, Time Warner, to, well, now called Warner Media. It's hard to keep track because the ink was barely dry on the acquisition from just a couple of years ago with the AT&T's acquisition of those assets.
And you go way back, I think, of AT&T getting together with TCI way back when. I mean, there's just...
Don't forget AOL, too,
it's
between
just,
those.
Where's the org chart? Let's get into it about this latest move that brings together assets like CNN, HBO, HGTV, and Food Network. Lucas Shaw covers the media and entertainment industry. He's entertainment reporter at Bloomberg News on the phone from LA. So, Lucas, who wins in this deal?
David Zaslav seems like the pretty clear winner. He's the CEO of Discovery. He's been, as best anyone can tell, trying to sell his company for 2, 3, 4 years, really make any kind of deal with anyone because they have been a pretty clearly undersized media company. And instead of trying to sell the thing, he now sits on top of, what is the 3rd or 4th biggest entertainment company empire in the world.
And is it enough, though, to take on Netflix and Disney Plus?
It's a tough question to answer just because it seems to me as though HBO Max, which is the big service that they're getting as part of this deal, was doing fairly well. Was it growing as quickly as Disney was? No. It was growing more quickly than Netflix in the U.S. from a smaller base, of course. It was on the precipice of rolling out overseas. And I think we're about to get a really good sense of sort of how this service was going to do on a global scale, which is the big question. And this deal, much like the AT&T Time Warner deal, could not really come at a worse time. The AT&T buys Time Warner just as Time Warner is preparing to kind of figure out its direct-to-consumer strategy for HBO. Instead, Time Warner sells. Then their efforts to turn HBO Max into a real thing, or what was then HBO Now, essentially get pause for 2-3 years. So then HBO Max debuts late after Disney Plus instead of first. And once again, right as HBO Max is about to roll out internationally, they introduce a ton more confusion. I just think it's got to be very difficult if you're one of these people trying to make HBO Max a real competitor with Netflix and Disney Plus to have to go through reorganizations and layoffs multiple times in just a couple of years.
Now, you said that Zaslav is now sitting on top of the third or fourth biggest media empire in the world, or in the U.S.?
Certainly in the U.S.
Okay.
I'd have to look at the exact size, and it depends a little bit on what you consider media. I would say it's one of the biggest entertainment empires. If you go into media, Facebook and Google are media companies. Some of the big Chinese tech companies are media companies because they sell ads and they sell subscriptions.
Right.
But as a kind of a pure entertainment company, it's really Disney, kind of Netflix, and then this one.
Well, and listen, it's a huge pie out there. So is it okay if you're just number 3 or number 4? Is there enough to go around, Lucas, that makes this a pretty viable entity going forward, or maybe not so much?
Look, that depends on what your ambitions are. You can certainly make plenty of money being the 3rd or 4th biggest streaming service, just like you could have made plenty of money pre-streaming being the 3rd or 4th biggest TV network. But Discovery, for example, was in a position where they weren't going to be number 3 or 4. They were having to position themselves as a niche, mid-sized player. It was clear that they were never entirely comfortable with that positioning, which is why they were on the market. And I think AT&T decided that the capital required to invest in HBO Max to make it the number 3 or 4 player, which would be, $10, $15, $20 billion a year, was something it just didn't want to do.
Hey,
but
Lucas,
at the end of the day, sorry, go ahead.
So no, please go.
I think being 3rd to Netflix and Disney is a pretty good position to be in.
Yeah.
Lucas, what is HBO's identity after this? Because it's something I've thought a lot about in the wake of the AT&T acquisition and sort of this transformation into HBO Max. Because HBO years ago was this avant-garde, right? It was this place for documentaries. It was this place that
cutting edge. Right?
It was really cutting edge, and a lot of that had to do with Richard Plepler, who of course is no longer there. But what is HBO's identity after this? Is it still a place for really high quality content?
And just got about 30 seconds.
Its identity is very much in flux. It was already in flux and expanding to HBO Max and bringing in lots of other types of programming. Now, when you factor in all the reality that goes in, I don't know what the name HBO means anymore. It's something that they're going to try to define over the next several years.
All right, I'm going to squeeze in another 5 seconds. Could somebody else come in, a Comcast or somebody, and say, wait a minute, we want these assets? Just quickly.
Yeah, there have been a lot of rumors, and I've heard of interest on the part of NBCU, but now the kind of chatter is, will they go after a Viacom CBS?
I love it. Stuff and play. Lucas Shaw, thank you so much. He's entertainment reporter at Bloomberg News, joining us on the phone from Los Angeles. Check him out on Twitter at Lucas_Shaw.
Let's get a check on the latest world and national news with Karen Chase in the Bloomberg newsroom in New York. Hey, Karen.
Good afternoon. President Biden is planning to begin sharing excess supplies of COVID vaccines. The president just announced he'll export 20 million more doses of Pfizer, Moderna, and Johnson & Johnson to other countries on top of the 60 million AstraZeneca he'd already planned to export as supplies begin to outstrip demand in the U.S. The president also said he'll be speaking to Israel's prime minister today about growing violence in Israel and Gaza. More from Bloomberg's Irv Chapman.
Blinken made clear that Hamas rocket attacks sparked the violent conflict.
I believe Israel, as a democracy, has an extra burden to do everything possible to avoid civilian casualties, even as it defends itself. We are ready to lend support if the parties seek a ceasefire. We'll continue to conduct intensive diplomacy to bring this current cycle of violence to an end.
Blinken also referred to continued support, however distant the prospect, for a Palestinian state peacefully coexisting with Israel. In Washington, Irv Chapman, Bloomberg Radio.
As we continue to emerge from the pandemic, New York Governor Andrew Cuomo announced that the New York City Marathon will step off this November and crowd capacity will be increased for NBA playoffs. Residents of New Jersey, Massachusetts, and Connecticut will face the highest tax burdens over a lifetime, according to a new study. Jersey residents will pay an average of $931,000, well above the $827,000 for Massachusetts residents and $805,000 for Connecticut. Nationwide, by the way, Americans will pay $525,000 over their lives, according to the study from financial technology company Self. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karen Chase, and this is Bloomberg.
All right, Karen, thank you so much. So he loves me not. He loves me, he loves me not.
Well, Twitter he loves.
Yeah.
Bitcoin,
all in on
who
that.
knows?
Oh, no, didn't he take himself off Twitter at one point? Did he like back off or
I think maybe he did, and
like,
it was for a few days.
Yeah, it was like
we've all done that, right? You just kind of you delete the app from your phone. You say enough with this thing, and then you come back 3 days later.
Exactly. I can't stay away. So anyway, we're talking about Elon Musk, and we're talking about Bitcoin.
Yeah, so he's now blowing up the Wall Street case for Bitcoin. This was a really big surprise last week, at the end of the week, when he tweeted that Bitcoin was no longer something they would accept at Tesla, considering that it was just a few months ago that he added Bitcoin to Tesla's balance sheet, and then at this point, not so long ago when he said that Tesla would accept Bitcoin as payment for autos.
Well, it's interesting. If you follow his Twitter feed, like I'm just looking at, this was 12 hours ago. To clarify speculation, Tesla has not sold any Bitcoin. I mean, there's a lot of questions about, do you like it? Do you not? Is it on your balance sheet? Are you accepting it? Are you not? And this is where, like, if we were in, God, if this was a stock or something, a publicly held, like the regulators would be like, Elon.
They have done that before with Elon's Twitter account, where he sent material information that they deemed was not necessarily.
But on Bitcoin, you know what I'm saying? Like,
Bitcoin, yeah.
it just shows,
totally.
It speaks to, there's not a lot of oversight on this. Like, regulators are still trying to figure this out.
And that's why he came in and clarified it really early this morning, at least New York time, that Tesla still had Bitcoin, because he left some response in a tweet late yesterday that indicated there was some confusion around that, and then you saw Bitcoin's price plummet even more.
Yeah, exactly. It's right now down 1.4%. It was down 8.6% over on Sunday specifically, and down another 2% on Saturday. But listen, this is something that's volatile to begin with, or can be, and then you kind of layer this on top of it, and it makes it tricky.
Look, the big questions I have moving forward is, what does it mean for the future of the cryptocurrency? Does Elon Musk change his position if there is some sort of, on a different type of cryptocurrency that is less environmentally unfriendly? Who knows?
And where are his handlers who are saying,
he does not have handlers.
Please step away from Twitter.
He was on SNL. He has no handlers.
It all started then. All right, you're listening to Bloomberg Business Week. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Down Monday, the Dow, the S&P, NASDAQ are all declining, with the S&P down 22, lower by about 0.5%. NASDAQ is down 134, down 1%. Dow Industrials down 115, a drop of 0.3%. 10-year yield 1.63%. Gold up 1.3%, 18.66 the ounce. West Texas Intermediate crude up 1.3%, 66.22 a barrel. Stocks lower, dollar weakening as investors weigh risks to the economic outlook, including inflation and the spike in COVID-19 cases in parts of the world. Again, recapping, stocks are lower with the S&P down 22, lower now by 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Got it. Thank you so much, Charlie. Well, in the new issue of Bloomberg Businessweek magazine, an excerpt from a new book out by Bloomberg News Projects and Investigations reporter Lauren Eder. Her book, The Devil's Playbook, Big Tobacco, Juul, and the Addiction of a New Generation. We talked about it on Friday.
Yeah, it's just a fantastic excerpt, and I'm excited to read the book as a result of reading this in Bloomberg Businessweek. Joel Weber's editor at Bloomberg Businessweek. He's joining us in the Bloomberg Interactive Brokers studio. Lauren Eder, Projects and Investigations reporter at Bloomberg News, joins us on the phone from Los Angeles. Joel, if we were talking about this 3 years ago, we'd be talking about how high-flying Juul is and how they just got this huge investment from Altria. Quite a bit has changed.
Yeah, I think when that happened, everyone was like, whoa, Juul, this is for real. Yeah. And then, a few years later, things have changed a little bit. Yeah. What I thought was so interesting about this particular chapter that we excerpted from Lauren's book is the untold nature of how things began to turn against Juul. And Lauren, let's kick it over to you. Tell me about Atherton, which is the richest town in America. And there are some very wealthy parents who discovered a little bit about their kids having maybe some interests in a certain tobacco product.
Yes. So what's fascinating about this particular story and about this particular place in America is this is actually something that was happening across the country in literally every city across America. So what made this particular story resonate was because it happened to be in Atherton, but like you said, the wealthiest city in America. And the product Juul was actually taking over this school, this very renowned private school in Atherton called Sacred Heart Schools. And kids of the parents were getting addicted to the product. They were having their peers use the product, and it was just infiltrating this community. So just like with infiltrating communities across America, but they stepped on the third rail when they basically got involved with these parents who said, we have got to do something about this. And what made this particular story even more unique was that the then CEO of Juul, Kevin Burns, happened to live in Atherton. He lived 5 minutes away from all of these individuals who I write about. And so there was a particular fury that had developed in the community because they're like, well, wait a minute. There are people in our own community who are making money off of this while it's invading our schools and addicting our children to one of the most highly addictive drugs that's around, which is nicotine.
Well, Lauren, there's fury, and then there's fury from very influential people who happen to be parents of these kids. Talk to us about that.
Yeah, so these weren't just any parents. These were, Pete Brigger, who's a very well-known co-CEO of Fortress Investment Group. He found out about his daughter's lacrosse team, there were players on the lacrosse team who had gotten addicted to it, and that's how he kind of found out about the product and realized that, wow, this is something that's bigger than, just a little something that the kids are doing. This was actually gripping their lives, interfering with their lives. And so he realized he needed to do something about it. At the same time, there were other parents who were involved. Dave Burke, who is a very prominent individual and has an investment company in the Stanford community. His peer group, his teenage kids, their peers were using Juul. And so they all kind of connected. And then Jim Steyer, who's a very well-known Stanford professor, whose brother happens to be Tom Steyer, the billionaire, and one-time former presidential candidate, they realized that their kids were also using Juul as well. So it was just kind of this conflagration, that started in Atherton, but that was actually happening around the country. So this was just one kind of zeroing in on one community that had these issues that were kind of highlighted at a very high level.
As you point out in your piece, Altria now values its 35% stake in Juul at $1.5 billion. That would imply a valuation below $5 billion from a peak of $38 billion, a serious decline from just a few years ago. How much of the issues that Juul has faced in the years since has been a result of what these parents have done, the regulatory issues, the changes in the years since has been a result of what these parents have done, the regulatory issues, the changes in what they're allowed to sell and where they're allowed to sell it?
Well, it was a lot of things were happening at the same time. So it's not only these parents that, led Juul to where Juul is today. I mean, there were attorneys general that were investigating. Congress was investigating the company. There were, plaintiff lawyers all across the country that were filing lawsuits. So it was, the parents are just kind of one piece of the puzzle that really came and put all of this pressure on Juul, but they were a not insubstantial kind of player. They tied into this other group in New York. There were some moms there who founded an anti-vaping organization called Parents Against Vaping E-Cigarettes. And so that has become one of the most prominent anti-vaping groups in the country, lobbying to get, more regulations against the product. So, yeah, they definitely played a part. They did not play the only part, of course. It was just kind of this entire storm that hit Juul and then, has also now hit Altria as well.
And if we know anything about sort of big tobacco, kids are sacred, right? Like in the moment that you sort of end up on watching, the under 18 crowd with nicotine, it seems like it really sends America into outrage, Lauren. But I'm also very curious. You've got many other chapters in this book. We only excerpted one of them. What else do you want people to know about the book?
Yes. Well, I want to comment on what you said about the kids and why the kids are such an important part of this entire story. It's because in the 90s, when the tobacco industry was under fire from regulators for the first time, it was the kids that really, this realization that youth nicotine addiction is powering the profits of the tobacco industry. Not more than 90% of adult smokers begin smoking before they turn 18, before they leave high school. 99% of adult smokers don't start smoking before the age of 25. Start smoking before the age of 25, which means that if you don't have kids who are addicted to nicotine, you're not going to have a next generation of smokers. So that's why public policy has always targeted youth nicotine addiction, and which is why Juul stepped on the third rail when they started getting kids addicted to nicotine. So yes, there are multiple chapters in my book. It's really 4 interwoven stories. It's a story of Juul in Silicon Valley. It's a story of big tobacco and the history of the tobacco industry and sort of their desperate struggle to remain relevant in a declining industry. It's also the story of regulators struggling to regulate this controversial product. And then it's, of course, the story of the parents as well and the teens who became addicted. So there's a lot of material in there. Yes, this is just a very small part of the overall book. But there's definitely many, many issues to talk about. And nicotine is highly relevant right now because the Biden administration has put out some potential policy proposals that will further regulate nicotine in America.
Well, lucky for us, you're going to come back because the book comes out next week, and we're going to have you back to talk some more because this is, if you think about the life cycle of this, it's just happened so quickly from kind of peak to pulling back.
Well, it's so the story of Silicon Valley, right? Of just like instantly make this impact, and because of the drug nature of this one, it seems like there's just the fallout just continues.
All right. Of course, that's Joel Weber, editor of Bloomberg Businessweek, and Lauren Etter. She'll be back next week. The Devil's Playbook, Big Tobacco, Juul, and the Addiction of a New Generation is her book. For those of you listening in New York, D.C., and San Francisco, watching on YouTube, Businessweek's coming back. If you're listening on Bloomberg 106.1 in Boston, Bay State Business, that's next.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. We move into the final hour of trading on this Monday, May 17th. A back-to-work Monday, red on the screen, but we are off session lows. S&P down now by 13, right to the numbers, dropping 0.3%. The Dow down 55, lower by 0.2. NASDAQ down 100 points. Another day of technology weakness. We've got NASDAQ down by about 0.8%. The NASDAQ 100 index down 1% today. Apple and Microsoft certainly weighing on the NASDAQ 100 index. Apple shares down 1.5%. Microsoft now tumbling by 1.6%. Stocks are falling as investors weigh risks to the economic outlook, including inflation and a spike in COVID-19 cases in parts of the world. Technology and communication services leading the S&P 500 into the red for the first time in 3 sessions. As for the economic backdrop, Victoria Fernandez is chief market strategist at Cross Market Investments.
I'm not concerned with the labor market. I think those are, just as people are talking about transitory inflation, I think the issues we're seeing in the labor market are transitory as well, and we'll see that start to do better in the fall. So I do think we're sitting well with manufacturing, services, with labor. We just have to get out from underneath this pandemic cloud that really is affecting all the numbers that we're seeing.
AT&T is spinning off its media operations in a deal with Discovery Inc. that will create a new entertainment company, merging assets ranging from CNN and HBO to HDTV, HGTV, and the Food Network. Coming up, Bloomberg Television and Radio. We'll be speaking with AT&T CEO John Stankey and Discovery CEO David Zaslav. Shares of both companies are trading lower. We've got AT&T down now by about 0.9%. Discovery lower now by 5.4%. Recapping the Dow, the S&P, NASDAQ all lower. 10-year yield 1.63%. S&P's down 13, a drop right now of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Bloomberg Business Week with Carol Masser and Tim Stenovic, live from the Interactive Brokers studio in New York. Bloomberg Business Week is brought to you by SEI. Asset managers don't get results that are off the charts when their solutions are off the shelf. Learn how SEI's operating platform can turn infrastructure into a competitive advantage at SEIC.com/IMS.
All right, so Tim, shortly we're going to hear from our David Weston. He's going to be sitting down with Discovery CEO David Zaslav and AT&T CEO John Stankey in a simulcast on TV and radio to talk about the collaboration, combining their media assets, basically AT&T getting out of it, spinning it off into a new entity with Discovery. David Zaslav going to oversee that new entity. So we'll talk about that in just a moment. But in terms of what else is coming up in our broadcast, we're going to talk a little bit about the Bloomberg Big Take, which happens to be a big crunch, more specifically about how in a supercharged economy, companies are panic buying. We've been talking about this because we've seen the run up in commodity prices.
I was reading this story and I'm like, wait a second, this is what every American was doing with toilet paper 14 months ago. Now they're just doing it with like lumber and every commodity they can get their hands on.
It's the post-pandemic version of it, right?
It is.
No, but listen, they're like, kind of hoarding. I was thinking about inventory and like just-in-time inventory, just to have what you need when you need it. Well, that's not what's happening.
Yeah, it's not the case anymore. I think if there's one thing we've learned over the past 14 months is that just-in-time has been called into question with all those supply chain constraints.
Right, stockpiles. That's how I grew up. There was always a stockpile of a lot of stuff.
All right, next time we run out of stuff, we're coming over.
Yeah, exactly. Hey, also, Wall Street has continued to evolve and be disrupted. There's an old Wall Street firm, Brown Brothers Harriman, that has just seen so many different cycles, been around for 2 centuries, and the author of a new book is going to come on and talk about that firm.
Plus, someone who knows a thing or two about cars.
Yeah, Jay Leno. How cool is this? He's sitting down with our car guru here at Bloomberg Business Week, Hannah Elliott. It's all part of the Bloomberg Live virtual event called the Business Week. Every day, a new vertical that's in the magazine. Today, it was about businesses and companies, and so we're going to talk about the business of classic cars.
Yeah, how to shop for a classic car. You can learn that from Jay Leno and Hannah coming up.
I need a lot of money to do that, don't we?
Yeah.
Although he shows that you don't have to, which is kind of interesting.
Does he?
Does he really?
I didn't know that.
It costs a lot, though, to fix him up.
He loves his cars.
That's where it gets expensive. We are going to get back to, though, the big story of the day, and that is, of course, AT&T and Discovery merging their media assets, building an entertainment giant. We heard from our Lucas Shaw. It's going to be a big player here in the United States. Getting ready to sit down, our own David Weston, sitting down with Discovery CEO David Zaslav and AT&T CEO John Stankey in a live Bloomberg TV and radio simulcast. Let's listen in.
We are now joined by the CEOs of the hour, maybe the day, maybe the year before we're done here. They're the CEOs of Discovery, David Zaslav, as well as CEO of AT&T. He is John Stankey. So thank you both very much for joining us. I want to start with changes of directions. And I'll start with you, David, and then I'll turn to you, John. David, this is something of a 180-degree change for you. You prided yourself in being involved in non-scripted, relatively inexpensive production programming. Warner is exactly the opposite of that. Very high-end, expensive, scripted. What caused you to have a change of heart?
Well, first, in many ways, we're really in the same business. We're both global IP companies. And we've been on a mission to aggregate more compelling stories and characters and IP in the U.S., which is why we did the Scripps deal with HG and Food, and why we got into business with Oprah and Chip and Jo. And so, you know, even though our content may be less expensive, we still aggregate to about 20 to 25% of viewership, depending on any given night in the U.S. And outside the U.S., we're the leader in sports in Europe with Eurosport, and we have free-to-air channels in a number of markets where we're like NBC or CBS, as well as being in the cable nonfiction business. But John and I are really aligned in strategically trying to get to scale above the globe, to be a meaningful, scaled competitor. And in order to do that, you need great content that people love. And one of the things that we looked at, we launched Discovery Plus, very strong, great product, great reviews and app ratings, and people are using the product for 3 hours a day. But we looked at what John has: King Kong, Godzilla, the incredible brand of HBO, Sex and the City, Game of Thrones, Superman, Batman. And we started to think about it as a combustible combination. You got some incredible IP that people will pay for before they'll pay for dinner. And then we have a bigger library than Netflix with content that people love, whether it's Oprah or Chip and Jo or Food Network or HG or the BBC content, Planet Earth. And so I think this is just a way that kind of assures that Warner, probably the top of the pyramid in quality IP and quality talent that's loved all around the world, together with the content that we have, where we are already the largest global media company. We have more global IP than anyone else, and when we come together, we think it makes us a real formidable global IP business to compete with the best in the business.
So John, David says that you're at least in the same sort of business, even if they're different ends of the business. But you've also had something of a change of heart here. There was a major strategic decision made to really move into the media business as a telephone company. And now you're really reversing that. You're going to go back to your roots, the telephone company. Let me understand. Looking back at it now, was the strategy wrong, or did something change in between? Because let's be frank, you're leaving some money on the table. There is some value being destroyed.
Well, I'd probably dispute whether or not there's value being destroyed. I'd actually say that we've managed to increase the value of the assets we bought by maybe about 30%. If you look at the cash we've taken out of the business, the assets we sold, and the effective value of this transaction, and some reasonable assumptions that once it trades as to how it's going to trade at a multiple.
John, I just want to make sure I understand that. I think you bought it at $85 billion. This is $43 billion. Are you saying you got that difference out in cash?
Well, we're getting $43 billion in cash, and we're getting 71% of the equity of the new business. So there's two parts to that. And the point of view that I think I'd have on this is the team's done a remarkable job of pivoting the asset to be effective in the direct-to-consumer world. And that's really the value that I think David and the rest of the industry see it right now. Now, what changed since we went into this was originally a point of view that this would help our connectivity business. And indeed it has. It's lowered churn. It's helped us on customer acquisition on things like selling more broadband connections. And it's raised customer satisfaction on those products. But in 2016, I don't think we had a clear picture of what the global opportunity was going to be in direct-to-consumer and whether or not that was going to be essential to playing in that space. And it's become clear that, as David just described, it's in fact going to be global. And the market opportunity for that, the value creation opportunity, is significant. It's so much more significant than the value that we get back into our connectivity business domestically in the United States to drive down churn and improve our customer acquisition, that I can't in good conscience not allow these assets to develop to their full potential, and to give it the kind of exposure in the market that it needs, to get the kind of multiple on it that we just talked about that will increase value, that the share owners of AT&T at 71% will carry forward. This is the right move at this time to actually make that happen, given the changes in the environment.
So, David, the opportunity, David, really is that by putting our assets together in media, we think that we're not just better together, but that we're probably the best media company in the world. We have the most IP, we have the most in-language content, we have the greatest diversity of content, and for John, you know, the vision here is that, you know, 2 years from now, 3 years from now, 5 years from now, we're the #1 media company in the world, and AT&T is the #1 telecom communications company in the world. And we take along 70% of our shareholders are John's shareholders, and we're creating value for them if this, you know, if we can do everything we think we can.
So, David, I would be disappointed if you didn't have really high expectations, and I think everybody's rooting for you. At the same time, even with this really large conglomeration you're putting together here, you're still well behind Netflix and well behind Disney when it comes to subscribers in the OTT space. How are you going to make that up? And very specifically, how much you're going to have to invest in content? If you take this combined entity, will you be spending as much more or less than the two individual on content going forward?
Well, we're going to be spending a lot more than Netflix. Right now, it's between the two of us, we're spending $20 billion a year on content, and we expect to spend more than that. Together, right now, we have almost 100 million subscribers, and neither one of us have really deployed aggressively outside the U.S. And we're differentiated in a meaningful way in the U.S. now with the extraordinary IP that John and his team have built together with Discovery. It's a very differentiated and compelling offering. However we do it, whether we put it all together at one price or whether we do it as a bundle the way Disney has. And around the world, we have between 10 and 12 channels in every country. And we've been outside the U.S. for over 15 years. So as part of this offering, we also have a big library of in-language content. And we got teams on the ground everywhere in the world to drive the international. So we think we're very well positioned to drive this. And we have the kind of IP and the stories that are coming out of Warner Brothers are stories that are loved everywhere in the world.
John, let me turn to your business, as it will be after this deal is concluded, and talk about specifically 5G. AT&T has fallen behind T-Mobile in that area. What kind of investments do you need to make to catch up and pass to be #1 specifically in the 5G space?
Well, T-Mobile clearly had an opportunity given the merger with Sprint where they picked up some spectrum that was suitable for 5G deployment. And that allowed them to move a little bit quicker in that area and actually cover a little broader cross-section of the United States. However, our 5G network is very present in major metropolitan areas all over the United States, which is good news for us, the bulk of where our customers are. And I think as you've seen by our momentum in the last several quarters, customers are voting with their feet, and they like the offers that we have in the market. They like our overall service proposition. And they like the way our network is performing. It is the fastest 4G LTE network, plus a great 5G network on top of it. And that gives a very consistent and effective service experience. And we're only getting better. We purchased quite a bit of spectrum in the last government spectrum auction. Some of that will go online late this year. And as it starts to go online, it will begin to close that gap with T-Mobile. So we feel comfortable that we're moving in the right direction. We'll keep that gap manageable right now from a performance and service perspective. And as the year moves on through next year and with this increased investment and focus, we'll be sitting in a really good position relative to our competitors on 5G. And that's, in fact, one of the reasons why we are trying to get the balance sheet in a little better shape here.
David, let me wrap up with you. As you know so well, you've been around this business a long time. The success of many mergers comes from really putting together the assets. Do you plan to really put together the assets of Warner Brothers, for example, with what you're doing in Discovery, or will you run them separately, sort of the way Bob Iger did with Pixar?
We're going to run them together, one culture, and the culture is going to be a creative culture. How do we invest in the best talent, the greatest stories, the best writers, the best producers? That's what John has been doing at Warner Brothers TV, at HBO, at the motion picture business. When I turn HBO on, I'll watch content that my first instinct on any other platform, I might not watch it. I might not watch an Alabama football documentary. But if it's on HBO, the storytelling is another level, and that's the quality of the Warner business. Our conviction for great storytelling, great characters at Discovery, and I think there's room for a company that really embraces the creative community, with support and fun and plenty of funding, and a platform that we can take it all around the world. So I think with these assets together, we're going to have a hell of a run.
John, you put some really attractive assets up in play, as it were. Is there room for another company to come in and make an offer to try to break this thing up?
Well, look, we did this transaction because we wanted to do this transaction. We thought it was a great match. We think the content's incredibly complementary. We think it's got a really strong process and path to approval in the regulatory environments. We think the management teams will gel well together. And for all those reasons, I think we've constructed a transaction that's really sound and solid, including voting agreements with some of the large minority shareholders in Discovery that basically has about 45% of the vote already set up for the transaction. So we feel we've got a very strong contract. We have a very strong approach. We want this transaction to close. We want that kind of knowledge and certainty for our employees. And we're going to keep moving down that path. I'm pretty confident we're going to get that done.
Well, as I say, you guys are the CEOs of the hour, and maybe the week, the month, the year before we're done. Thank you so very much to Discovery CEO, Discovery CEO David Zaslav, as well as AT&T CEO John Stankey. Back to you.
All right, you've been listening to David Weston, as he said, talking with the CEOs of AT&T and Discovery. This as AT&T agreed to spin off its media operations, doing a deal with Discovery. It's creating a new entertainment company, merging an array, Tim, of assets.
Yeah, the big thing, though, taking on Netflix, taking on Disney, trying to become dominant when it comes to streaming in a way that they weren't able to do as separate companies.
Yeah, absolutely. So we're going to continue monitoring it and watching the stocks, and we'll see if it's done or whether there's somebody outside that comes in and says, wait, we can make you a better offer.
Hey, it's going to be a while before the deal closes. Plenty of time.
Exactly. Speaking of time, it's time to come back to work. That's what JP Morgan is saying. And sitting outside JP Morgan headquarters in New York City is Ritika Gupta of Bloomberg News. So Ritika, what are you seeing in terms of workers coming back? And I'm not sure if you've had a chance to talk with anybody, but kind of set the scene for us.
Yeah, it seems to be quite lively around here. I've been seeing a whole host of Patagonia vests and people coming in and outside the JP Morgan headquarters here in New York. They've all been wearing masks. Even though the CDC mandate is now that you don't have to wear the mask. So that's been interesting, a sign clearly saying on JP Morgan's building that you've got to wear them. But this building has actually been open throughout the pandemic. But JP Morgan's offices throughout the U.S. now being open to its employees on a voluntary basis. This, of course, we know ahead of the requirement that all workers will have to start going back into the office in July, at least on a rotational basis. And we know a lot of other firms in this industry are going to be watching this closely. This is really going to be setting the precedent here.
Yeah, Ritika, talk a little bit about that and how other firms are watching what JP Morgan does, because it's not, of course, just about JP Morgan. It's also about the other large financial firms, not just in the area where you're standing right now and the people you're around, but those other large firms that are just up and down the block from you.
Yeah, well, what we know is that the likes of Citigroup, Wells Fargo, Bank of America, they're going to be asking their workers to come back partially post-Labor Day. Goldman Sachs being the exception, they're going to ask them to come by mid-June. But JP Morgan really here acting as the bellwether and getting the first major bank to actually have a mandate to get all of the workers back on a rotational basis by July here. So that's really big. I was also reading, and I think this was quite telling, that JP Morgan are actually getting about 30 to 40 of their investment bankers actually traveling daily within the US to meet clients. And I thought that was interesting because if clients are actually having these meetings now, then just due to the competitive nature of banking, other banks are going to have to follow suit with JP Morgan here, just on that basis alone.
Ritika Gupta, live outside JP Morgan headquarters in New York. Thanks so much. This is Bloomberg.
This is The Big Take, the best of Bloomberg's in-depth original reporting from around the globe.
What we have to make sure we do as the economy recovers is look at the data kind of broken down a bit.
These funds are becoming more and more expensive. You're looking at sort of $15 billion for their entry level.
There have been waves of immigration that have faced a lot of resistance.
A lot of color behind the scenes and a great untold story.
How did Bezos really come out on top? As the cover says, Jeff wins. He always seems to win.
The Big Take on Bloomberg Radio.
All right, it is time for the Bloomberg Big Take, and on this Monday, it's actually the Big Crunch. Listen, we've talked about hoarding so much during the pandemic.
Yeah, and it's not just customers, American consumers.
Wasn't funny when I couldn't get toilet paper. I'm just going to tell you.
There's nothing funny about that. But it's also not funny when large industrial companies can't get their hands on their inputs.
Right. And is it just, disruptions in the supply chains, or is it, inflationary, and what does it mean longer term, right?
Expectations of disruptions.
Exactly. So let's get into it, and let's get to the story with Brendan Murray. He is trade czar at Bloomberg News, joining us on the phone from London. This is the story, Brendan, we all needed, especially as we spent last week being concerned about inflation, then not worried about inflation, and we saw that play out in the financial markets. What's going on? Why are companies panicking?
Yeah, so inflation doesn't just show up on the store shelf. It builds in the economy over months and months. And I think what we're seeing now is some of those industrial inputs, things like chemicals and plastics and rubber and other things, that normally just kind of fly under the radar, really causing some tightness and causing companies a lot of pain. I talked to a mattress maker who can't get any foam, who tries to get this in the U.S. And obviously, mattresses without foam is not a business that you want to be in. And so this particular business owner is saying, look, I can get by for a couple of months, but I don't have anything in my inventory, and this is really going to start to hurt. So he's paying a lot more for it if he can get his hands on it. And ultimately, he says, look, I'm going to have to pass that off onto the customer. So I think there's just lots of examples like that where just kind of name your product and it's in short supply.
Well, it's sort of this perfect confluence of events, as you and our colleagues point out in the piece. It's the freak accident in the Suez Canal. It's drought wreaking havoc upon agricultural crops, a deep freeze and mass blackout wiping out energy and petrochemical operations in the U.S., not to mention what happened with the pipeline just last week. Talk to us a little bit about expectations for how long this crunch is going to last, because you and your colleagues write about something that's known as the Logistics Managers Index. What is that, and what does it tell us?
Right. So, if you listen to what Fed officials say, they say, well, this inflation is transitory. Well, what does that mean? Does that mean it's gone in 3 months, or does that mean it's here for the next couple of years? So if you listen to people who are in the logistics industry, that is transportation, warehousing, kind of moving products from production to the consumer, they're looking at the tightness all around them and saying that this is not transitory in a 3 to 6 month kind of way. This is more something that's going to be with us. The Logistics Manager Index that's cited in the story is a survey, like a lot of other surveys that produce economic data. This one particularly asks, where are your transportation costs going to be 12 months from now? And the survey overwhelmingly shows that those costs are going to be higher if, the same or higher 12 months from now. So these are shipping costs, trucking, basic delivery costs. We're all going and buying stuff on Amazon, and there are surcharges for delivery fees and that kind of thing. So, across the board, it seems that if it is transitory, it's more of the 1 to 2 year kind of time frame rather than just a couple of months sort of an episode.
Well, Brendan, that's what I wanted to ask you, and just got about 30 seconds. Any conclusive takeaway about, is it transitory, or is it just, listen, the economy coming back faster and bigger than we all thought?
Yeah, I think transitory. If we're talking, a year or two, maybe three, that you can, the world needs container ships right now, but you can't. It takes 2 to 3 years to build a container ship, so the capacity is going to take some time, and I think it's going to take some time for us to work through this.
2 to 3 years doesn't feel transitory.
Transitory's in the eye of the beholder, I guess.
Build those container ships. Brendan Murray, it's a great story, and it's the Bloomberg Big Take. It's also the Big Crunch, as we call it on the Bloomberg. Trades are Bloomberg News on the phone from London. You're listening to Bloomberg Businessweek. Chart of the day. It's back. That's coming up next.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
I can't cheat anymore without him noticing.
What do you mean?
Because he's back in the studio.
Oh, yeah. Dave Wilson back in the studio.
I know. I will.
Well, fortunately, I'm sitting far away from him. He can't see what I'm doing.
Feeling you may not get the song, but I think you'll get the artist.
Okay. All right. I like
you have an advantage.
I like that he has confidence in me. Anyway,
you have an advantage over Tim.
You know his dulcet tones. Dave Wilson is back. So is the chart of the day. We're going to get to that in just a moment.
In the meantime, let's get a check of the trading day with Charlie Bella. Charlie, what's the latest?
We've got 28 minutes to go ahead of the closing bell. This update brought to you by BNY Mellon's Pershing. To learn why Insight is the essential event for the financial advice community, register now at BNYMellonInsight.com. It starts June 8th. Stocks lower as investors weigh the risks to the economic outlook, including inflation. S&P down 17, lower by 0.4%. We've got the Dow down 79, down 0.2. NASDAQ lower now by 0.7. 10-year yield 1.64%. Gold up 1.2%, higher by $22 the ounce at $18.66. West Texas Intermediate crude up 1.5%, $66.32 a barrel. AT&T is spinning off its media operations in a deal with Discovery that will create a new entertainment giant, merging assets ranging from CNN and HBO to HDTV and the Food Network. Bloomberg Television and Radio spoke moments ago with AT&T CEO John Stankey and the Discovery CEO David Zaslav.
We looked at what John has, King Kong, Godzilla, the incredible brand of HBO, Sex and the City, Game of Thrones, Superman, Batman. And we started to think about it as a combustible combination.
Shares of AT&T down by 2.2%, Discovery down 4.5%. U.S. is recording its lowest number of new coronavirus infections since the early days of the pandemic. The CDC recently revising its mask guidance for vaccinated Americans, meaning people who've had their shots are clear to shed masks at most times. Dr. Joshua Sharfstein is Vice Dean at the Johns Hopkins Bloomberg School of Public Health.
I think what's changed is new research showing just how rare it is for people who've been vaccinated to get sick, and also how rare it is for people who are vaccinated to pass the virus along to others. So it's not impossible. Neither of those things are impossible, but it's very rare, and it's much more effective, say, than the flu vaccine or other vaccines that we commonly take.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine names, Pfizer up 0.3%, ADRs of its German partner BioNTech up 3%, AstraZeneca, its ADRs up 1.1%, Moderna down 0.8%, Johnson & Johnson down 0.3. Recapping stocks lower, S&P down 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie Pellet. Bloomberg Business Week is brought to you by Stevens Institute of Technology, offering top-ranked technology-driven graduate programs in business, data science, and analytics. On campus or online, classes begin May 20th. stevens.edu/grad. This is Bloomberg.
It's like deja vu all over again.
Carol, you know this voice.
I'm listening.
Yeah. And sound, too.
Come on, sing again.
Okay, I'll give you a 3-letter hint. C-C-R.
Oh. Creedence Clearwater Revival.
Oh.
And therefore?
It's,
lead singer, main songwriter.
Carol's got it.
Center field.
I know, I can't think of it. I'm totally mind.
What's going on, Dave?
It's a Monday brain.
John Fogerty is going on.
John Fogerty.
There you
is
go.
Is that an old one?
No, actually, that's one of his solo recordings. Actually, it was the title track of an album from 2004 called Deja Vu All Over Again.
Nice.
Yeah, absolutely. Seemed to fit with the chart.
Do you have a little sun on you?
I have a little something. Sun.
You look really rested and healthy.
Well, if you say so.
Okay.
In any case, this may be actually, if you're a Bloomberg Terminal customer, this is deja vu because this chart actually went out a week ago while I was on vacation. But I haven't had a chance to talk about it or send it to my email subscribers, so now's the time. And it's really kind of an evergreen in a sense. It's something that Michael Hartnett put together. He's the chief global investment strategist at Bank of America, really trying to kind of get some perspective on where we are now to where we were in the dot-com era and its aftermath. And Berkshire Hathaway is sort of his reference point. So what he did was basically look at a ratio between Cathie Wood's flagship exchange-traded fund, ARK Innovation, and Berkshire's shares.
Right.
And for my chart, I chose the Class B stock because that's what's in the S&P 500 and whatnot. And then he went back historically and made a comparison between Invesco and Berkshire. And I say Invesco, big fund manager at the time, one of the beneficiaries of the dot-com boom in the late 90s, and of course, one of the companies hurt by the bust that followed. So, it's putting it all together that you could perhaps see a little bit of deja vu all over again.
Right, deja vu. So meaning what then in terms of, because listen, there's a lot of attention being put on Cathie Wood and ARK Investment right now in terms of the pullback from the highs. I mean, at the highs, we were talking about $60 billion in assets under management. It's come way down to about 40. And listen, her bets are on tech, disruption, innovation. We know big time Tesla. So what's the connection here?
The thing is that the chart kind of extends out to what would be late 2022. Using the sort of the Invesco Berkshire ratio as a reference point. More declines to come. In essence, if there is a real historical parallel. It's more illustrative, arguably, than anything else. But if you haven't seen it, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
I think of what you pointed out from Warren Buffett, his annual meeting, Berkshire Hathaway, and he put up some charts. Right? You have I think it was the top global market cap companies.
30 years ago, maybe.
Exactly, to say, and none of them are around, none of them are in that ranking today. And to his point being that, listen, the companies that are the big players were probably, those that are big now won't be around, and then new ones will come out.
By the way, we should be watching after the close of trading because it's the deadline for institutional investors to file their quarterly reports, and that means we'll be hearing from Berkshire sometime after 4 p.m. New York time.
Oh, so this is a perfect chart for the day.
Well, you could argue that. I will tell you quickly, my stock of the day is Children's Place, which is actually at its highest price since September 2019. A couple of analysts got behind the apparel retailer. Maness Crespi raising its rating on the stock to buy from neutral. Wedbush with an equivalent increase. And since, according to our data, there are only 6 analysts that follow the stock, having 2 of them raise their ratings, it gets people's attention.
It is
no question.
It is on a tear, up 78% this year.
Yeah, and now the analysts kind of add on to that, and you're talking about a stock that's having quite the day, up almost 15% at the moment.
That's a big play. Good stuff. Dave Wilson, thank you so much. Good to have you back in studio and back from your week off.
Let's go check out world and national news with Karen Chase in the Bloomberg Newsroom. Hey, Karen.
Hey, the Supreme Court has agreed to take up a major case on the hot-button issue of abortion. Bloomberg's Amy Morris tells us justices will hear a controversial case out of Mississippi on a law that outlaws most abortions after 15 weeks of pregnancy.
The Mississippi case seeks to allow states to outlaw abortion even before a fetus is viable. That eviscerates the core holding of a 1992 ruling which says states can't impose significant restrictions before viability. Conservative states have been moving to sharply restrict abortion rights. So far in 2021 alone, states have enacted more than 60 new abortion restrictions. The Supreme Court will hear this case in the upcoming term that begins in October. In Washington, I'm Amy Morris, Bloomberg Radio.
Police in major cities nationwide are gearing up for a potentially violent summer. Departments in New York, D.C., L.A., and many others are bulking up patrols and implementing new tactics to prepare for possible violence as states lift COVID restrictions and more people pack public spaces in warmer weather. Travel is taking off. United Airlines is ramping up its flight schedules as more people regain their confidence about traveling. United is adding another 400 flights to its July schedule over the number of flights in June. Former Treasury Secretary Steve Mnuchin just sold his Manhattan co-op apartment. The Park Avenue duplex was recently listed at $25.7 million, down 21% from its original asking price. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karen Chase, and this is Bloomberg.
All right, Karen Chase, thank you so much. Carol Massar, Tim Stanovic in our Interactive Brokers studio here at Bloomberg headquarters in New York City. So we talked with Ritika Gupta. She's outside JP Morgan headquarters with this as JP Morgan workers come back to work. In the meantime, Mike Mayo, very influential analyst when it comes to the banking community and to Wall Street, he's looking for some major job cuts.
Yeah, he's at Wells Fargo, and he says the U.S. banking industry could slash as many as 200,000 jobs in the coming decade. This as revenue growth slows and the pandemic accelerates automation and the adoption of digital services. Carol, one thing that we've talked about a lot over the last 14 months has been what does automation look like on the other side? To what extent can certain tasks be automated? And one thing we've heard from banks, especially in the last quarter, was the rise of fintech,
right?
And the way that these big banks are actually looking to those who are disrupting the traditional space right now with those fintech players.
So I was curious, like 200,000 sounds like a lot, and it is a lot. But here's just for some context: JP Morgan employs about 259,000 people. Bank of America employs over 212,000 people. Wells Fargo employs over 268,000. Goldman Sachs about 40,000 people, or 40,000. So. It's a lot, but I just wanted to give some context.
That's good context, and it's also a question of like where are these jobs and what kind of jobs are the ones that end up getting automated. And, you know, it strikes me as something that I saw a few years ago, Carol, when I went into a bank branch that wasn't actually a bank branch. It was sort of this experimental, here is a mix between an ATM and like a virtual machine that you can use to actually talk to a live human on video chat who's somewhere else in the country.
Right.
And it worked.
It worked. I think many would say this is the natural progression of things, that there are certain services that are going to be automated, which potentially frees people up to maybe learn new skills, and maybe they're moving to a more significant position that pays more. So maybe people get to move up the scale.
Well, that's the hope.
Right, that is the hope. Anyway, we're watching the banking sector in a big way. All right, you're listening to Bloomberg Businessweek. Carol Massar, Tim Stanovic. We're going to count you down to the close on this Monday right here on Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell on this Monday, May 17th, with the Dow, the S&P, and NASDAQ all trading lower. We're off session lows, but still a drop of 0.3% right now on the S&P, down 10 points now at 41.63. The Dow's down 40, a drop there of 0.1%. NASDAQ is down 67, a drop of 0.5%. 10-year yield 1.63%. Gold up 1.3%, 18.66 the ounce. West Texas Intermediate crude up 1.4%, 66.31 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, so bouncing around a little bit, but really down for the day here. We're off our worst levels of the session, as you just heard from Charlie. Let's get to the drive to the close. Back with us, Alan Zafran, founding partner, co-CEO at IEQ Capital, once again on the phone from Foster City, California. This is one of those days where I'm scratching my head a little bit, Alan. What do you make of the trade?
Carol, great to be on again. What I make of the trade is this market is churning. Put it in context. We've been up so much since the bottom a year ago, and so we're looking for any excuse we can find. It could be inflation, it could be tweets from Elon Musk, it could be anything in between. We need a little bit of profit taking. We need people just to calm down a little bit, and markets don't go up forever. So this is just the natural churning of markets. It can't be as easy as it was to make money in the last 12 months. This is just noise. That's really what I make of it. Nothing more than noise.
So how do you make money in a market that's full of noise like this?
You stay with your long-term perspective. You recognize that historically stocks go up about 10% per year. And as one of my colleagues said, pain is the price of being in the stock market. You're going to get days and weeks when you're down. If you don't put too many eggs in any one basket and make sure you have enough cash on the sidelines for rainy days and emergencies, you can have a long-term perspective.
You make it sound so easy. You make it sound so easy, Alan.
Well, isn't it also?
It were.
Yeah, but also thank you index funds. I mean, don't you think the amount of money that has gone into index funds and basically buying the market has created kind of a certain level of calm within the market that even when there's some selling, Alan, you can kind of see it play out. It pulls back a little bit and then everybody comes right back in.
Yeah, you see that. That's part of it. And I think part of it is, again, thanks to the Fed and everyone else, cash is trash. You don't make any money, and bond yields are deplorable. They really don't keep up with inflation. So if you're really a long-term saver, sitting in public cash and public bonds isn't going to build a big nest egg. And so that's why I think money inevitably flows back into stocks. The alternatives just are not attractive. Tina, there is no alternative.
Don't say it. You've done it.
That's the cult of equities we've been living in for all. But, so let's take this a different way. One of the arguments is stocks are overvalued. So maybe we're trading at, I'm picking a number, 22 times forward earnings. And if you look in the last 25 years, it's only about 16 times forward earnings. Wow, we're way overvalued. But then you have to say to yourself two things. One is, 25 years ago, and along the way, interest rates were a lot higher than they are today. So stocks are relatively more attractive. And the other thing is the stocks from 25 years ago were ExxonMobil, and they were General Motors and AT&T, these capital-intensive businesses with lousy profit margins. Today, it's Apple, it's Google, it's Facebook, and those margins on those businesses are better. And so you should probably be paying a somewhat higher multiple than what you did 20 to 25 years ago. Maybe not as high as it is, but certainly it doesn't mean it has to go back to what it was. So I think we have a fallacy of thinking the old days have to repeat entirely. So I think there's justification for where stocks are. Sure, you're going to get crazy swings of up and down, but I don't think stocks are as grossly or even nearly overvalued as some of the bears would tell you. I don't see that at all. I think it makes complete sense given where we are with the interest rate environment, where we are with the relatively low inflation environment, despite the recent surge, stocks still make a lot of sense for a long-term investor.
So, Alan, I want to go back to something you said about fixed income. Is there any place for fixed income in a diversified portfolio right now for a long-term investor?
Absolutely, for three reasons. One is we don't really know where rates are headed. We know that they're a lot lower than wherever they were historically, but I could give you an argument we could turn into Japan. Yeah. And actually owning long-duration bonds make a lot of sense, too. At least the high-quality bonds really do have a negative correlation to stocks in the long run, so it diversifies you. And third, there's a lot of flavors of bonds. You certainly could buy senior floating rate bonds that keep up with inflation. There are elements of high yield bonds. If you buy enough of them, even if there are some defaults, probably the excess income you earn relative to a treasury makes up for some of the losses along the way. So there's absolutely room for fixed income. But the reality is you basically count on the yield you're going to earn when you buy. And right now that yield is pretty darn low. So it's not really terribly compelling. It's a good diversifier, but it's going to be hard to build a retirement nest egg on public fixed income today. There's just not enough return.
Hey, what about retail? It is up just shy of 10% as a whole. If I'm looking at the S&P Super Composite Retailing Industry Group, it's up almost 48% from 52 weeks ago. We're going to hear from a lot of big names in the retail space. How do you see retail? Are there opportunities there?
Yeah, well, I think this COVID has only accelerated the separation of the rich and the poor. So I think luxury retail is actually quite compelling, as it always has been, because I think people coming out of this pandemic are going to want to spend, and those that financially benefited will be able to have the wherewithal to actually spend. I would argue, though, that retail as a generalization is not an overwhelmingly compelling sector to us, to me. And the reason is it's still heavily dependent on economic cycles. And I believe the economy, albeit being very robust this year, we're going to get back to where we were before COVID. It's going to be a plodding, slow, grinding economy, and there's only going to be a handful of winners that really drive durable differentiation. It's going to be a challenging sector once we get past this near-term sugar high from all the fiscal and monetary stimulus we've had.
Why will it be challenging?
Because we got to go back to the basics. Our economy before COVID, if you recall, was grinding slowly. We have an aging population. People that age don't spend as much. Look at Japan or Europe. Mm-hmm. We have technologies pushing down all forms of inflation pressures, and you have a growing debt load. That growing debt load is going to ultimately slow down the pace at which we invest and we spend. The government debt load slows down the ability of this economy to grow, and servicing that debt is going to slow it down, and taxing the rich is going to also slow down economic growth. So however you cut it, once we get past these next 6 to 12 months, we're going to go back into a slow grinding economy again.
Do you think it'll only take, and I say only, you think it'll only take 6 to 12 months for that to happen?
Yeah, depending on how much you want to push the Fed's foot to the fire on fomenting inflation. The Fed is adamant about creating inflation because as bad as inflation is, deflation is worse. If I say, here's a pen, I'll sell it to you for $1, and you say, I don't want to buy it, it's going to be dropped to 98 cents tomorrow. So I show up tomorrow and say, hey, you're right, why don't you buy this pen at 98 cents? You say, well, I'm not going to buy it, and wait till it drops to 96 cents tomorrow. You'll never buy my pen, and so there's no economic growth. Deflation is terrible. And that's why the Fed is fomenting inflation. It's adamant we got to kickstart this economy, or we're going to become Japan. That's the alternative.
You don't think infrastructure spending might kickstart the economy?
It will, but again, given we're going to go through a compromise, we're going to end up at a dollar amount that's going to be nice to stimulate some growth, but it's not going to be enough to change these long-term secular problematic slowing down economic forces, which is massive amounts of debt, higher taxes on the rich, and an aging population. All of those secular long-term forces are going to keep economic growth down and, all things equal, inflationary pressures down. Therefore, you do have room to buy some bonds or fixed income in your portfolio, not just as a diversifier, but the reality is, in the long run, interest rates are very unlikely to go up meaningfully like where they were 10 years ago. It's unlikely they'll get there.
I wonder what that means for real estate. If interest rates stay so low, don't we just see real estate continue to climb higher and higher? And we only have about 30 seconds.
You do, because you get a lot of income generation from the real estate, and you can do rent increases, which probably go at the faster pace inflation. So we are advocates of owning broadly diversified real estate as part of a well-diversified portfolio.
All right, we're going to leave it on that note. Good stuff. Covered a lot of ground, as we always do with Alan Safran. He's founding partner, co-CEO at IEQ Capital, on the phone from Foster City, California. It's an interesting day. He gave us a lot to think about, whether it's thinking about, historically, stocks do gain 10% a year if we look at it. We've certainly seen, that play out for a long time. So it's something to think about.
It is. Keep it simple. Keep it simple.
Keep it simple.
It's like the way he explained it. It's just so logical.
The trend is your friend. Are you going to go there?
Just set it and forget it.
Oh, my God. All right, coming up next, everybody, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and on YouTube, counting you down to the closing bell on this Monday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Romaine Bostic, Taylor Riggs, Caroline Hyde, back in the seat, counting you down to the closing bell, here to help take us beyond the bell. Our global simulcast team, Carol Massar and Tim Stenovich, bringing together our Bloomberg television, radio, and YouTube audiences worldwide, parsing all the moments of the day. Carol?
Yeah, this has been a weird day for me. I mean, I just feel like the market indices, the major market averages have been kind of all around the place. We're off our highs, we're off our lows. Energy, your top performer, but a lot of those big tech names, Tim, we're seeing them at the bottom. The stocks really weighing on the trade today as well.
Yeah, tech, utilities, and of course, media and communication services leading the decline today. We're going to have more on that in just a second. You mentioned semiconductor stocks continue to be under pressure. Something I got my eye on, earnings tomorrow. We're going to hear from Walmart, Macy's, Home Depot. That's going to help us think about and really learn about how these executives are thinking about the second quarter and the remainder of the year.
And dare I say it, some of those inflationary pressures, Caroline, and some of the higher input costs, as of course materials are some of the highest sectors on the day as well. And thinking about pass-through onto the consumer, we joke when we say this, we're not being entirely serious, but higher inflation is in essence a tax on the consumer. How do these companies respond?
I never joked it.
How easily can you pass it on? Exactly. I mean, we've been interviewing CEO after CEO. It was just Casper of last week. Mattresses, they're having to sort of find the way in which you can have price inelasticity. But how much of these retail companies remain are going to be able to do that? And also the supply chain issues that potentially might be biting.
Yeah, I mean, these are certainly real issues, and we do joke about it from time to time. But look, for all the agita out there, we should point out, look, the S&P 500 right now is only down about 2% from that May 7th high. Industrials and transports only down fractionally, less than 1%, basically about 3 or 4% from those all-time highs. The NASDAQ, of course, not quite in as good a shape, down about 6% from its highs. The closing bell here has you down about 0.2%, 0.3% on the S&P 500 on the day. NASDAQ down 0.4%. Dow Jones Industrial Average down 56 points, or about 0.2%. The Russell 2000, though, managing to squeak into the green, up about 0.1% on the day.
Yeah, just kind of squeezing it out. Energy, too, really one of our top performers. This is a group that we've seen really gaining this year overall, and again, up about 2.3%, Taylor, so really kind of leading the way here.
And how much of that Russell 2000, those domestic-focused stocks, that inflationary, reflationary trade is really filtering through when we look at a sector level? Because the sectors basically tell you everything that you need to know on the day. With airlines, value trade, the reopening back in vogue today, it is energy and materials that are up 1 to 2%. Banks are also up about 0.8% as we talk, of course, about higher yields today. Yields aren't catching a bid despite some of the sell-off within the equity markets. And Carol, I'm just going to bring you down to the one loser that you need to know. It is telecom services. It's off 1.8%. Why don't you guess it? It's Verizon, it's AT&T, it is T-Mobile. It is a big merger Monday.
Yeah, actually reacting big time fundamentally to that news. Hey guys, have you heard of Chia, the now new cryptocurrency? It's an alternative.
Yeah. We have now.
Well, listen, Western Digital and Seagate, they're saying thank you very much, Chia, because they are rallying big time this year. They're up about 6% in today's session. And this has to do with, Chia is seen kind of as an alternate cryptocurrency. It uses high capacity drives, specifically Seagate and Western Digital make them, so they continue to gain big time. Do also want to mention Trip.com. They're going to report after the closing bell yesterday. It's that economic recovery play. Morgan Stanley did an upgrade on that travel rebound, so we saw that stock up about 4%. And I did just want to mention Regeneron. This was a top gainer in the NASDAQ 100, up a little bit more than 1% here, but they did a phase 3 trial trial of a drug, one of their drugs, and it showed that it could be used in terms of COVID, maybe cutting some of the death risks there. So just a little bit of a biotech play here, Tim.
You got the gainers, I got the decliners, and you heard Taylor, talk a little bit about what's going on when it comes to the media play today. And look, it's all about that media merger Monday, and it is having repercussions much past Discovery and AT&T. Comcast finishing the day down more than 5.5%, lower after Bloomberg Intelligence said that the AT&T Discovery deal may spark Comcast interest in a deal for its NBC unit. Charter Communications also lower, this one by more than 3%. Charter perhaps lower over concern that a combined AT&T Discovery could have more leverage over those content negotiations, charge more for those. Disney down more than 2% after all. This deal is about taking on Disney and Netflix. And I had to throw Airbnb into this one, tumbling more than 6% today. This all because that last IPO lockdown expires. We saw some selling there, Caroline.
Yeah, people want to be able to sometimes cash in and be able to go and spend their hard-earned shares that they've been winning, so maybe a little bit more selling pressure on Airbnb. What's also had some selling pressure, well, I mean, it's been a really mixed bag if you look at commodities spectrum, guys. So going into your global macro movers for our radio and TV audiences, as well as you out there on YouTube, I'm looking at gas getting pushed higher on the back of searing heat. That took the bears by surprise. We're seeing that gas up about 5.3%. Metal's getting a good bid, but this was an interesting narrative. The China retail sales data not looking so pretty overnight. That sort of fed into the FX story because that sort of saw money move into the US dollar. We saw a little bit of a bid for a haven. The Singapore dollar off by 0.2%. Worries about COVID strains over in Asia, but the Canadian dollar continuing to rally up 0.3% on a tear. This all to do with the commodities narrative. The fact that commodities have been rallying. Yes, we take a breather in the likes of lumber today and some of the other ag businesses, but generally copper's back up, but notably for the CAD and the loonie, as we call it, Taylor, it is the fact that oil is back rallying on the day.
And so are yields, right? That inflationary, reflationary theme, Caroline, which we talked about at the end of last week. You had a huge move up in yields. So despite catching a bid at the end of the week, you're still higher on the week. And that theme continues as well today, right? You're up 1 to 2 basis points on the board. But let's be honest, Carol, no one cares about yields. They only care about AT&T and Discovery, right? And
yes,
across the board, pretty much all the analyst notes had highlighted not only how much they loved this deal, but really then the threat of what that meant to the competitors. Every analyst note that I read also had mentioned Netflix and Disney in it.
Yeah, well, it's interesting, and certainly the two CEOs involved, Discovery and AT&T, they really liked it, and I think it'll be, Tim, the test of time, whether or not, you know, getting together, collaborating together, creating this huge media entity, whether or not they can compete against the likes of Netflix or Amazon or Disney.
Yeah, that's the big question, and it's one that was posed by David Weston, who spoke with David Zaslav and John Stankey, the CEOs of Discovery and AT&T, just about an hour ago. Let's hear what David Zaslav had to say. Take a listen.
Well, we're going to be spending a lot more than Netflix. Right now, it's between the two of us, we're spending $20 billion a year on content, and we expect to spend more than that. Together, right now, we have almost 100 million subscribers, and neither one of us have really deployed aggressively outside the U.S., and we're differentiated in a meaningful way in the U.S. now with the extraordinary IP that John and his team have built together with Discovery. It's a very differentiated and compelling offering.
$20 billion on content, a significant amount of money. But look, everybody's spending money on content, not just Amazon and Netflix and Disney, but of course Apple as well, Romaine. And my big question is, yeah, of course, Apple's spending a ton on content.
I'm sorry, when does this stop? Because at some point, you have this fire hose, and you see this with Netflix. They have to continue to spend.
Yeah.
The second they pull back on spending, all their subscribers go down, investors freak out, then they have to ramp it back up. What's the end point here? Are they going to get to a stage where they're really going to have the pricing power to account for that spending, or is this just kind of constantly be spend, 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 so you can get your more, Oprahs and your Chip Gaines, and I don't even know who else do they have on there. Caroline, you have a show on there?
You and I remain, and all of us should be, we should be asking for one. Meanwhile, though, Taylor, I mean, are we all going to be rebundling all our various packages that we're getting? But more seriously, this is a move for AT&T, your world of debt. They had to cut back on their debt. They're getting money, $43 billion in. They're going to be able to perhaps pay off what had been an M&A spree under the previous leader that doesn't seem to have been a smart spree to many.
Hang on. When you say previous leader, Stankey was there. He was the president and CEO who kind of helped orchestrate this as well. So, yeah.
Well, in 2018.
I blame him.
shift in tone.
Wow.
I will bring it back politely to the debt conversation, Caroline, that you so eloquently alluded it to. And look, the most heavily indebted non-financial company, they have worked a lot on trying to reduce that debt to leverage ratio. Romain knows that formula at the back of his hand, trying to come under Verizon, of course. And Caroline, you had mentioned some of those big 5G spectrum spends, Carol, that also come into play when you're thinking about what a new AT&T looks like.
I feel like AT&T has been trying to find itself for years. I go back to the TCI merger, and what's really fascinating, John Malone, whenever he's involved, it's always an interesting structure, you know, and it's always a deal, like, what is it called? A tax advantage reverse Morris Trust. Like, everybody's been Googling what that is, but I wouldn't ever count him out, because John Malone has been doing this, Tim, for a long time. Or what, Romain?
Well, Carol, but you say AT&T has gone through all these iterations. What about Warner? I mean, that's been quite the saga there. You go back to the days of Ted Turner, AOL. You got the bidding by Rupert Murdoch. They've gone through so many iterations. You kind of wonder, what's their identity at this point, now that they're getting absorbed into Discovery?
Well, it's interesting because we're all saying everybody wants content, and we know that, Tim, but it's, listen, you know, hits or misses. We can see this moving a lot in the last few years.
For so many years, it was HBO's hit after hit after hit. So much of that came under Richard Plepler. He's over at Apple now, helping create content at Apple. What is the future of HBO with a Discovery AT&T tie-up, or Warner Media tie-up? That's what I want to know.
All right, and apologies to John Stanky there. I don't blame you.
All right,
Take
good
it all
stuff.
back. Stick to your word, Romain.
No, I flip-flop all the time.
Don't we all? All right, that's going to do it for our cross-platform coverage, everyone. On Bloomberg Radio, Bloomberg TV, and on YouTube. We'll see you again tomorrow, same place, same time.
This is Bloomberg Businessweek with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's amazing. We had a conversation. We didn't even talk about crypto stocks tumbling.
You know, I can talk about the media story forever, Carol.
Well,
I'm
listen.
really passionate about it, and it's just look what happened to Verizon earlier this year. You know, selling off its media assets. It's almost like telecom companies. They don't want to do media.
They're moving around a lot, and it's interesting in an environment where we keep saying content is king, and yet people keep to be saying, "Here, wait, you want it? I'll sell it."
So, what does it look like after this?
I don't know. I think what's also happening is that there are companies that are shedding assets to be more of a pure play, and maybe that's where AT&T is coming from.
It's like a cycle.
Yes, it is. And then they build up again, and then they shed the assets. You have a good night.
Thank you. You too. I'll see you tomorrow.
I'll see you tomorrow. All right, let's get back to world and national news. For that, we turn things over to Karen Chase. She's in D.C. Hey, Karen.
Hey, Carol. President Biden gave an update on his administration's COVID response efforts, announcing plans to share 80 million COVID vaccines with other countries and keeping up his push for all Americans to get vaccinated. In another sign of pandemic rebound, the number of Americans flying is nearing 2 million passengers a day. Bloomberg's Irv Chapman has a look ahead.
As more business people return to the office, business travel should recover, but that won't happen until the fall, Scott Kirby, chief executive of United Airlines, said in a Bloomberg interview.
Domestic leisure travel is more than 100% recovered, and people are out in droves to unite with each other and to reconnect. The airports are crowded now. They're crowded all with people traveling on leisure travel.
International travel, though, will remain in the doldrums until countries recover from the pandemic, Kirby said, a reminder that it's an interdependent world. In Washington, Irv Chapman, Bloomberg Radio.
United is adding 400 more flights to its July schedule than its June schedule. United is seen as the most customer-friendly airline for those trying to log their COVID tests or vaccination proof. The pandemic accelerated e-commerce's share of U.S. retail sales, and that shift is likely to strengthen in the years ahead, according to Bloomberg Intelligence. Analysts say new sales channels in social media and voice and video commerce should compound the push triggered by lockdowns, resulting in digital grabbing 35% of total retail revenue by 2025. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karen Chase, and this is Bloomberg.
Thank you so much, Karen Chase. You are listening to Bloomberg Business Week. Carol Masser joined with Charlie Pellet of Bloomberg News. He's back and went on a trip, but he did not go. Well, you did go on a plane, didn't you?
I had to fly out to Denver to get on an Amtrak train to go cross country, and I had to fly back from Los Angeles. And I got to tell you, going out was basically so empty that I managed to score an upgrade to the front of the plane, which doesn't happen very often.
Nice.
Coming back, it was packed to the gills.
Yeah, see? All right. So listen, we know summer vacations are coming back. So too are the airline algorithms that know how much you're prepared to pay for them. It's so interesting. The CEO of United Airlines, we just heard a little bit in Karen Chase's report, but did an interview with our Brooke Sutherland for the Bloomberg Live, the Bloomberg Businessweek event, live virtual event. And he was talking about airfares because they were saying, Brooke actually said, listen, I tried to book an airfare to go home to Kansas. And I was like, oh my God, how expensive it was. And he made the point of saying, well, the fares are still down from like pre-pandemic levels, but they haven't necessarily added all the flights that they had pre-pandemic.
Indeed, and that Kirby interview was quite fascinating too, because he told Brooke that leisure travel is definitely back, and I saw that over the weekend.
More than 100.
Yeah, it was clearly leisure travel. He said business travel, however, is not back. And then the third bucket that they have to worry about, international travel, that's not coming back anytime soon.
Yeah, I think on business travel, he said it's still down like 75 to 80%, but he does expect it for us to see a significant change in the trend come September. So it'll be interesting to watch pricing, Charlie, right? As these airline algorithms that make us all crazy, like, why didn't I buy the fare yesterday? Because now it's $100 more. We'll have to see how they play out.
Exactly. When you talk to, your seatmate, if you do talk to your seatmate and you find out what they paid for the same fare that you did, that can be a strange conversation sometimes.
Well, think about the amount of stories that have been written about that, about you can be sitting next to somebody and it's a completely different price. And I can only imagine how sophisticated those algorithms are. All right, Charlie, thank you so much. You're listening to Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Just getting word from Berkshire Hathaway. It is boosting its stake in Kroger, Verizon, Restoration Hardware, and Marsh & McLennan in the first quarter. That according to Berkshire's 13F. Berkshire Hathaway's shares today lower by about 0.7%. We saw the Dow tumble 0.2% today, down 54 points. S&P down 10, a drop there of 0.2. Nasdaq down 50, a drop of 0.4%. 10-year yield 1.64%. Stocks lower for the first time in 3 sessions. The dollar weakened as investors mulled risks to the economic outlook, including inflation, along with a jump in COVID-19 cases in parts of the world. Gold up 1.2%, $18.65 the ounce. West Texas Intermediate crude up 1.5%, $66.34 a barrel. Recapping stocks lower, S&P down 10, down 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
So all this week, we're featuring segments from the Businessweek. It's a week-long event bringing the magazine to life, each day focusing on a section from the magazine and going hand-in-hand with this week's how-to issue. Well, today it was all about companies and industries, including how to shop for a classic car. 2 perfect people coming together to talk about it. Bloomberg Businessweek's auto columnist and writer Hannah Elliott, and someone known big time for his classic car collection, Jay Leno.
Bought a few cars in your time.
Yeah, I just never sell anything.
So talk me through your process. I mean, everyone I know just goes and bring a trailer and drools over cars.
Yeah.
Is that what you're doing too? Or
Well, it is the more money the brains club. And
Okay.
when you buy a car, it's a rational process made irrationally. You know, a lot of people say it's a terrible investment, classic cars. I heard from Chank O'Leary, you know, Mr. Wonderful talking about, he collects wine. That seems ridiculous to me, wine. Yeah. But cars, it's kinetic artwork, like the Lamborghini Miura. These are now worth minimum $1 million. This one I essentially got for free. I got it in the early 80s. Dean Martin bought it new.
Okay.
His son cracked the crankcase, the engine seat, you know, just...
It was rough.
It was rough. And back in those days, when you had an Italian car like this, you had to know someone in Italy who spoke Italian. You couldn't just call the factory and order parts.
How did you find out about this car?
A buddy of mine bought it. He was a teacher, and he thought it just got to be too much. And the wife said, things sit in the yard. Give it to Leno. You know, so it was one of those deals. See, it costs just as much to restore and repair a valuable car as it does a worthless car.
Yeah.
So you might as well start with something valuable. There are a lot of cars that were ahead of their time, in their time. They were just a little too expensive, or for some reason they didn't sell. I mean, the classic example would be the McLaren F1 over there. When that came out, it was about $1 million. And people thought, $1 million for a car, that's the most ridiculous, because Lamborghinis were $100,000. Then the recession hit. They were going to make 300 of those. They built 64. Couldn't sell them. The company shut down. They're only 64. They can't make any more. So the price of it went up.
Yeah.
You know, it's as simple. It's really the basic supply and demand.
When you go to look at a car, are you one of these guys who are bringing magnets, you know, to feel underneath
Well, here's the
car?
thing. The stuff I'm looking for, there aren't any. So if you find even the pieces of one, you buy them. Next door, I have a Doble steam car. They only built 40 of them. I have 2 of them. Okay, if you find one, it doesn't matter what condition it's in, just buy it.
Yeah.
Because you're not going to find another one.
How closely do you pay attention to mileage or to factory original?
I never look at mileage.
Okay.
You know, I meet guys all the time that I've got a Ferrari Enzo. I've had it 15 years. It's got 9 miles on it. Well, that's in worse shape than a car that's being driven regularly. So something that has normal mileage. These are mechanical things. They, you know, oil is blood, and they need to circulate. It needs to keep the car running. So high mileage doesn't interest me.
Okay, so what's the appeal with the Corvair?
Well, the Corvair is an interesting choice because you can buy them for a couple of hundred, even maybe a few $1,000s. It's air-cooled. It's rear engine, like a Porsche. There's no radiator. I find them fascinating. You know, Ralph Nader went after the Corvair in his book, and it got some bad press. And so consequently, the value of them went down. But they have a hardcore bunch of fans that love these things.
Did you have this car in mind? You were looking for it
I was
specifically?
looking for a Yanko Stingray.
Okay.
Yeah.
So how did you, without divulging all of your secrets, how did you find it?
I found it because you call the Corvair Club.
Uh-huh.
You see who has one. Anybody want to sell?
Oh.
Okay, and then people contact you.
It's easy.
And they say, yeah, this is what I want for it. You know, that's a little high, but this one was very good. It was very clean. It's nicely done. I said, okay, so I bought it from him.
Wow.
You know, whatever kind of car you're interested in, there's a club of that car. And you go on the website, and there's always an elderly person who'd been in the club for 15 or 20 years. They can't drive anymore. They'd like to sell their car. You might pay a little more, but you get a car that's been maintained.
Yes.
And exercised properly, and, you know, that type of thing. I have a car called a Tatra. It's Czechoslovakian. So one day I see a magazine, Tatra Club, Litchfield, England, or something like that. Okay. So I call it Tatra Club. Well, we have a Christmas party every year, of course. We all get together for that. And so I joined the, oh, good, this is $80 a year, blah, 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 blah. So I said to him, well, that sounds good. I said, how many people at the club? Including you? 4. Well, now I was the 4th guy. There's only 3 other guys. I go, what kind of Christmas party is that really? Just you and the other 3 guys, now me.
Yeah. Okay, tell me about the art of the deal. Are you a low ball offer kind of guy?
No.
Okay, tell me, walk me through this.
That. The people I buy cars from are more concerned that the car is maintained, that it's not flipped. If the car is what they say it is, I usually pay the price.
Really? You don't try to negotiate?
No, because I'm not trying to get, you know, I'll say, look, I'll pay you a price. Just tell me what's wrong with it. Okay, this needs to be in this. Okay, and then I make a judgment whether I want it or not. And all of this making money from cars is fairly new. The real trick is, if you buy something you like and it goes up in value, great. If it goes down in value, you weren't going to sell it anyway. You know, it's cheaper than hookers and cocaine.
Yeah.
Plus, your wife always knows when you come home reeking of transmission fluid.
Yes, she knows where you've been.
No, exactly.
Yeah, that's okay for all you wives out there. Listen, of course, that was our car expert, auto expert here at Bloomberg Pursuits and Bloomberg Businessweek, Hannah Elliott, of course, talking with Jay Leno. You can watch more Bloomberg Businessweek how-to events by signing up at BloombergLive.com, and you can check out that entire interview that Hannah did with Jay Leno. I love when he talked about the $25,000 Maserati, did some engine transmission work, a little bit more, and now he says it's probably worth about $300,000. So talk about an investment. Check out, though, more at Bloomberg Businessweek and BloombergLive.com. You're listening to Bloomberg Businessweek. Carol Masser in our Interactive Brokers studio. Coming up, we're talking about Brown Brothers Harriman. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Businessweek.
So this from the cover jacket of a book we're just going to talk about. Conspiracy theories have always swirled around Brown Brothers Harriman, and not without reason. We're going to talk about why and why this company has been at the center of so much over the past 200 years. We'll talk to the author, Zachary Karabell, in just a moment about his new book. In the meantime, let's get back to some of your top business stories, some of the market news. Here is Charlie Pellet.
Hi, thank you very much, Carol Master. Here's what's going on. Stocks lower, down Monday. Stocks declining for the first time in 3 sessions. The dollar weakened as investors mulled risks to the economic outlook, including inflation and a jump in COVID-19 cases in parts of the world. S&P down 10, a drop of 0.2%. The Dow down 54, lower by 0.2%. NASDAQ down 51, a drop of 0.4%. 10-year yield 1.64%. Gold up 1.2%, 18.65 the ounce. And West Texas Intermediate crude up 1.5%, 66.33 a barrel. Well, as for the overall mood of the market, Alan Zafran is founding partner and co-CEO at IEQ Capital. He was our guest right here on Bloomberg Businessweek.
We've been up so much since the bottom a year ago. And so we're looking for any excuse we can find. It could be inflation. It could be tweets from Elon Musk. It could be anything in between. We need a little bit of profit taking. We need people just to calm down a little bit. And markets don't go up forever. So this is just the natural churning of markets.
United Airlines is going to add more than 400 daily flights in July as travel demand bounces back to 80% of pre-pandemic levels. United CEO Scott Kirby spoke with Bloomberg Television. He says while leisure travelers are back, international travelers are not.
As long as international borders are closed, essentially long-haul international travel is going to be shut down. That may take a little longer, but it will ultimately happen, and we will get the borders open. So really good progress on recovery, really good indications of human nature with people wanting to get back and reconnect as soon as they can. So really encouraging, but we're not quite out of the tunnel yet because business demand and international is still closed.
And among some of the airline names, the Big Four, UAL up 2.3% today. American Airlines Group up 4.2%. Delta up by 1%. Southwest lower by 0.3%. Again, recapping, equities did move lower today. Gold, as I mentioned, up 1.2%. West Texas Intermediate crude 66.33 a barrel, up 1.5%. The S&P was down 10, down 0.2. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So it's a story in an iconic old Wall Street firm that has seen its share of financial cycles, booms and busts, 200 years old and counting, aging along with and experiencing American history as it happened. We're talking about one of the oldest private investment banks in the United States, Brown Brothers Harriman. And Zachary Karabell has a new book about the subject. He's a journalist and former finance executive, founder of the nonprofit and individual-supported The Progress Network, which was launched last year. It's all about finding a better future. His book, though, Inside Money, Brown Brothers Harriman and the American Way of Power. He joins us on the phone in New York City. Zachary, good to have you here with us. How are you? And what was it like writing this book?
It was unexpected. It took me a while to actually get into the mindset of a firm steeped in kind of quiet rectitude and, to find a narrative that kind of spoke to me and spoke to our president. I know that's an unusual thing for an author to say, that it took a while, but think of it like a lot of dating before we consummated the marriage.
Well, let me ask you something. Why Brown Brothers Harriman?
So, one, there's almost no firm that has spanned the entire lifetime of the independent United States that has kind of been present at the creation at every given moment. To some degree, think of Brown Brothers Harriman as Zelig, that film that came out 30, 40 years ago. At every important juncture in American history, there's a Brown Brothers banker in the top row to the left, innocuous but present. And it was a way of writing about the role of money in making American power in the 19th century and then in making the United States into a global power in the 20th, and then raising the questions of what should American capitalism be in the 21st.
So it was there at just like critical junctures, right? Like you think about what this firm has seen over its lifetime. And I have to say, what was it like then for a firm that has seen so much? What was it like going through the company's archives? Tell me, is it a basement with tons of boxes? What is it? I just paint the picture and tell me some of the stuff you came across.
There was a 150th anniversary. The last time Brown Brothers made really big press was its 150th anniversary party in 1968. And by the way, even though they say they were founded in 1818, it's kind of a made-up date. I won't go into the arcana of it. The firm really begins in 1800 when an Irish linen merchant emigrates from the Troubles in Ireland and goes to Baltimore and sets up shop and then brings all of his 4 sons into the business, and hence the Brown Brothers as the title. And for that 150th anniversary, they commissioned a corporate history. Companies do this all the time.
Right.
And then all the archives for this were taken and placed at the New York Historical Society. And I happen to live on the Upper West Side of Manhattan, which is where the New York Historical Society was. So of all the books I've ever done, it was by far the easiest research I've ever done. I could like roll out of bed and into the library. I know there were.
That's pretty sweet. So tell me some of the stuff you came across that you thought were critical in writing this book and helping you tell the story.
So you can break this really neatly into 19th, 20th, and I guess to some degree the coda of the 21st century. So in the 19th century, Brown Brothers is at the epicenter of this thing that made the United States unique relative to the old world. The old world, money is pretty much tied up in human capital, land, and then hard specie like gold and silver coins. And in the United States in the 19th century, you have this like efflorescence of paper promises, paper money, which had been around a little bit here and there over time. It's not like the United States invents that, but its proliferation and its utility and the ease of obtaining it was just so much greater in the 19th century. And it really unlocked a lot of human potential and created immense chaos and volatility. And Brown Brothers really creates some of the first paper to underwrite the transatlantic trade system, these letters of credit, which if you're in finance, you know, and if you're not in finance, is just kind of gobbledygook. But they were the lubricant for the entire international transatlantic trade system, including the whole cotton trade. And it's really what allowed the United States to develop at a kind of a hypercharged level in the 19th century. And I didn't even appreciate that as much until I sat down and wrote the book. And then we can get into the 20th century. I mean, they're the whole thing then is when the people who made money go into the centers of power and create the American establishment.
Well, hang on, because that's a perfect break point, because we got to go do some news, but we'll come back and talk about the 20th century because, you know, we talk about Goldman Sachs and their connection with government, but it's interesting, certainly when it comes to Brown Brothers Harriman and the impact that it has certainly had and reaching kind of the echelons, certainly within our society. So we're going to come back with Zachary Karabell, author of Inside Money, Brown Brothers Harriman and the American Way of Power. We'll continue in just a moment. In the meantime, let's get back to Karen Chase. She's in our D.C. bureau with a check on world and national news. Hi, Karen.
Good afternoon. President Biden is keeping up his push for all Americans to get vaccinated.
Above all, let's work together, though, to meet the target I've set of 70% of adults, all adults, with at least one shot by July the 4th.
The president also announced plans to send excess vaccines to other countries, 80 million doses in all of Pfizer, Moderna, and Johnson & Johnson. The CDC says all vaccinated Americans can drop their masks outside, and New York Governor Andrew Cuomo says he's dropping his state's mask mandate and social distancing rules too, starting this Wednesday, but only for the fully vaccinated.
By the CDC guidance, immunocompromised people, unvaccinated people should continue to wear a mask and social distance, but if you are vaccinated, you are safe. No masks, no social distancing.
New Jersey Governor Phil Murphy is lifting the mask mandate and the state's travel advisory today. Governor Cuomo also announced the New York City Marathon will go on this November, but with reduced capacity. Only 33,000 runners will be running. He also announced increased crowd capacity for the NBA playoffs. California will be keeping its mask mandate in place for at least another month. The state will lift it on June 15th when it plans to fully reopen its economy. It's all an effort to persuade more people to line up for those vaccines. And the U.S. Supreme Court will hear a controversial case on abortion this fall. Some say it could be the beginning of the overturning of Roe v. Wade, the 1973 decision legalizing abortion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karen Chase, and this is Bloomberg.
All right, Karen, thank you so much. You're listening to Bloomberg Businessweek. Carol Massar, and joining me once again is Charlie Pellet of Bloomberg News. Charlie, this story is among our most read on the Bloomberg in the past 8 hours. It involves the former Treasury Secretary, Steven Mnuchin, of course, Treasury Secretary under former President Donald Trump, just selling his Manhattan co-op apartment, and it was on sale.
Indeed, 740 Park, a 21% price cut that he had to take. And you know what? I can identify with the former Treasury Secretary. I'll tell you why. I've been doing a real estate deal of myself, a little bit different. Rental in Queens, but you won't believe the deal I got from a 2-bedroom in Brooklyn, 3-bedroom in Queens, and you know they threw in a $500 Amazon gift card, free cable for the year. I mean, this is a great time to be on the buying end of the equation.
Sounds like your kind of deal.
It really does, and a shorter commute, I might add.
Yeah, exactly. Well, his duplex, that's the iconic 740 Park Avenue. There's books written about this building. It's really kind of, old New York living, if you will. But it's interesting. I guess he originally asked about $32.5 million, and then it was most recently listed for $25.75 million, so 21% reduction. This is what's going on here, Charlie.
Indeed, and just a caveat, we won't know the final price until this whole thing is all tied up with a bow, submitted to the city. And the other thing I'm curious to is all about the co-op board, because here in New York with our co-ops, you've got the co-op board that has the final say on who gets to move in.
Yeah, it can be really tricky. Do want to also point out the most expensive co-op, this was the most expensive co-op to sell in Manhattan in the past 18 months. And as you said, the final price won't be known yet. You go up against that co-op board and they can be like, yeah, no thanks.
I've been rejected by a co-op board. I have, and I'll tell you why.
How could they reject the voice of the New York subway?
You never know. This was many, many, many years ago, and the reason I suspect I got rejected is we were buying a bank foreclosure, and I suspect they didn't want that to be the last recorded sale in the building.
Oh, interesting. All right. Charlie, that's just the way it goes sometimes. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Stocks fell as inflation unease lingered. We have the S&P down 10 points today, down another 0.2%. The Dow lower by 54, down 0.2. NASDAQ, the selling continues there, down 50 points today, down 0.4% for the year now. NASDAQ is up 3.8%. To put that in context, the S&P is up 10.8%. The Dow this year up by 12.1%. 10-year yield, 1.64%. Gold up 1.2%, 18.66 the ounce. West Texas Intermediate crude up 1.5%, 66.37 a barrel. Warren Buffett's Berkshire Hathaway exited a bet on Synchrony Financial as the company continued to pare back its investments in financial firms. Berkshire reporting that it no longer held any shares in Synchrony and also trimmed its Wells Fargo bet to just over 675,000 shares. Berkshire shares, the Class A stock, down 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Want to get back to our guest, right? Still with us is Zachary Karabell, who does have a new book out. It is called Inside Money, Brown Brothers Harriman and the American Way of Power. Zachary, a journalist and a former finance executive. So we were talking a little bit kind of in the early days of Brown Brothers Harriman and their history, because it's been around for a long time. The 20th century, though, was an important one for this firm. And I was looking in the book, it said, among the young men who were formed by the war was a generation of Brown Brothers partners who would catapult the firm not only to the center of Wall Street, but at the epicenter of a global system that they themselves designed. I mean, these were individuals, Brown Brothers individuals, who were really at the heart of so much.
Yeah, and the ones that would be familiar, or at least a little bit familiar, are Averell Harriman, who served as Secretary of Commerce, ambassador to Moscow during the heart of World War II, and then administrator of the entire Marshall Aid Plan to Europe, then governor of New York, and then in foreign policy roles in the Kennedy administration. A guy named Robert Lovett, who was very famous in his time, just kind of faded, and he's on cover of Time magazine. He became Undersecretary of State, really the creator in many ways at the Department of War, the precursor of the Pentagon, of the modern Air Force. You know, helped create the B-29 Superfortress bomber that dropped the atomic bombs, for better and for worse, on Japan. Yeah. And of course, Prescott Bush, who is the father of George Herbert Walker Bush and the grandfather of George W. Bush. So, and that's where a lot of the Bush family fortune comes from. It comes from his time at Brown Brothers Harriman. And this cohort of people, they all went to Yale, they all went to the same schools, became the heart of this elite that we called the establishment, that made what Henry Luce, the founding editor of Time magazine, also went to Yale, also funded by Brown Brothers Harriman, called the American Century. And they designed basically every institution globally, not just Brown Brothers, but their class, this cohort, from the World Bank to the World Trade Organization to the United Nations, the Pentagon, CIA, National Security Council, all comes from this class of people who made their money on Wall Street, made the money that made America, and then that money and that America made the world.
You know, Zachary, what's interesting, too, is this isn't a firm that, it certainly wasn't the biggest on Wall Street. It didn't go public, a la Goldman and others. And it's interesting, you write that there was never any serious discussion of going public. You know, it was partners who had decided, you know, that they didn't want to do a lot of the things that the other big banks ultimately on Wall Street were doing, whether it was in investment banking or underwriting the tech boom. They did it differently. And we all knew that. I know as a journalist, we all knew it, that they were different from the rest of the pack.
Yeah, and I do think that not going public is crucial. And I'm by hardly the first person to indicate that, because when these were partnerships, it limited the amount of risk that these firms could take with capital, because it was their money. It wasn't shareholder money. It wasn't leverage from a bank. And it changed the incentive structure. And I am not putting on rose-tinted glasses and saying, oh, wouldn't it be great if everything had stayed that way? My critique is that there needs to be a balance between speculation and investment, between long-term and short-term, between those who are willing to bet the farm and really risk on innovation, and those who are more small c conservative. And that at the heart of a system where money is volatile, money is powerful, money is like the power you unleash in an atom, I think you want a little more of the caution at the center and the risk at the periphery. And what's happened on Wall Street and in the financial world, I believe, in the past 30 years, and certainly we saw this in 2008, 2009, is that balance shifted, and speculation and more, as opposed to enough is enough, occupied the center, and the Brown brothers of the world, if they survived at all, ended up on the periphery. And I think that balance is skewed in a way that's unhealthy.
Why do you think it's important to tell the history of a firm like Brown Brothers?
So I use the phrase, I guess somewhat provocatively, of they are an example of sustainable capitalism. And sustainable not in the ESG sustainability sense, sustainable in literally what kind of form of capitalism is sustainable long-term societally. And there are a couple of elements of that. One is that the people who've profited greatly by the system believe they have a responsibility to the commons, that unless everybody is thriving, you cannot individually or corporately thrive for very long, hence the sustainability of a system. And also that the relentless pursuit of more, while it's certainly interesting and healthy for some people to do that, it can, again, get out of balance, that there is such a thing as enough. Doesn't mean that we shouldn't strive for a better future, a better world. I'm not suggesting that at all. But that the idea that only more is of value, and that if you can make as much as possible, as quickly as possible, that is to be lionized and rewarded. That can work as for individuals, but I think it doesn't sustain a healthy system. And I do believe there's an ethos that Brown Brothers had that is useful to think about, because we're constantly redefining capitalism. And our current notion of it, whether it's on the left to attack it or on the right to laud it, is a version of capitalism. It is not the version of capitalism.
Well, that's what I was thinking about, certainly coming off the financial crisis, a lot of criticism levied at the financial community, and at the same time, we need a healthy financial community, right, to have a strong economy. This is how you provide funding and, public markets and so on and so forth. But I do wonder, is there a lesson for today, looking at the history of Brown Brothers Harriman, is there a lesson for today in today's Wall Street and today's financial firms in contrast?
Again, I think it's more about culture and sensibility than it is necessarily about structure, right? I'm not saying Goldman Sachs and Morgan Stanley are not going to go private and become partnerships tomorrow. Even if they went private, they'd be owned by a private equity firm. They wouldn't be a partnership. But it is about an ethos of what's my responsibility to the greater good? To what degree should I be shaping the commons in a way that makes us all rising tide, lifting all boats, rather than my boat did very well and your boat sunk? And I think there's a lot tech elites could learn from that today, who seem to be largely missing in action when it comes to contributing to these discussions. And we're in a very different world, right? We're not going to recreate a small cosseted elite that went to a few schools, intermarried, and felt that it had a right to lead. And I don't think we should go back to that. But in a genuinely idealistic sense, and I don't really care if I sound naive or utopian,
right.
I think the idea that those with more need to give back, and that those with more have a responsibility to engage the public good, is both in their interest, in our interest, and regardless is an essential component to a healthy society.
Well, it was great to spend some time with you and talk about the book. So thanks so much for stopping by. Zachary Karabell, his new book is Inside Money, Brown Brothers Harriman and the American Way of Power. Really a great deep dive into their history. And you can read a little bit more about those conspiracy theories as well. S&P 500 ending on this Monday down 10 points. The Dow Jones Industrial Average a decline of 54 and the NASDAQ down 51 points. For the whole Bloomberg Businessweek team, have a good and safe evening. I'm Carol Massar, and this is Bloomberg Radio.
the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Media Deal Monday, a Bloomberg scoop. AT&T will combine its Warner Media division, including HBO, with Discovery in a $43 billion deal.